0.1%, and in the bond market, yields are still lower, down 4 basis points to about 4.16 on 10s. We'll have coverage of this story throughout this morning. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackett. Hey, Yahara.
Good morning, John. President Trump is playing the blame game as he pushes for a ceasefire agreement between Russia and Ukraine ahead of his 100th day in office. Trump lashed out at Russian President Vladimir Putin over the weekend, but turned his ire back to Volodymyr Zelensky yesterday, accusing Ukraine of trying to renegotiate an economic deal with the U.S. Meanwhile, Commerce Secretary Howard Lutnick could withhold promised CHIPS Act grants as he pushes companies to expand their projects in the U.S. Sources telling Bloomberg that Lutnick's goal is to generate tens of billions of dollars in additional investment without increasing the size of federal grants. And Elon Musk's SpaceX launched the first human spaceflight to fly over the Earth's north and south poles last night. The mission is carrying a crew of 4 private astronauts funded and commanded by cryptocurrency investor Chun Wang. The flight will last 3 to 5 days and will study the impact of spaceflight on human health. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on a program, Trump's tariff gamble.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. I think they have a chance of doing better, actually, with the tariffs. It could actually help them in a certain way. And I think a lot of them will drop their tariffs.
1 day to go. Up next on a program, Tobin Marcus of Wolf Research, live from New York City this morning. Good morning.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Live from New York, good morning to you all. Equity futures just a little softer. We're down by 0.1%. No drama in the equity market. In the bond market, yields still lower. 2-year, 10-year, 30-year. Yields down across the board, down 4 basis points on 10s to 4.1690. Under surveillance this morning, Trump's tariff gamble.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind. I think they have a chance of doing better, actually, with the tariffs. It could actually help them in a certain way. And I think a lot of them will drop their tariffs.
So here's the latest this morning. President Trump set to announce his reciprocal tariff plan tomorrow in the Rose Garden. The Washington Post reporting, quote, White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States. Bloomberg's Mike Shepard joins us now from Washington for more. Mike, that breaking news just moments ago, what do you make of that?
Well, in a way, it reflects what Donald Trump was saying on the campaign trail. You'll recall that he had floated this idea of universal tariffs on imports of all shapes and sizes and origins of up to 20% and going as high as 60% for goods coming in from China. So this really aligns with something he had been promising voters. But at the same time, many in Wall Street, many in business had simply regarded as maybe a negotiating position, maybe as something to get these trading partners to the negotiating table. But now that we are one day away from what Trump has been calling Liberation Day, it is starting to perhaps look like more of a day of reckoning. The president has framed these perhaps as reciprocal tariffs, but one of the challenges with doing these kind of country-specific, very bespoke tariffs is that you run the risk of creating some sort of trade and tariff arbitrage where countries will move production to lower tariff destinations. We even saw this during Trump's first administration when Chinese businesses moved some production to places like Vietnam and Malaysia and elsewhere that then exported those goods to the U.S.
Mike, coming in with a very high-end 20% tariff sounds like a maximalist approach. Could Trump still be looking to make deals with a number of trading partners?
Well, Trump is the first person to say he is looking to make a deal, and we have heard him talk about that in so many different areas, including the war in Ukraine and you name it. He really wants to try to reach an agreement. What he is looking for ultimately is, in his view, a better and fairer treatment of U.S. products and U.S. exporters on the global market. Now, how he defines those terms can conflict with how those trading partners view it. Take the European Union, for example. One of the Trump administration's biggest bugaboos with Europe has been the value-added tax. They see that as a trade disadvantage. On the other hand, in Europe, if you talk to officials there, which we all have, what we are hearing is a very different version of that. They don't see it as a trade instrument. They see it as simply taxing economic activity that happens within their borders. So to be able to get to the kind of agreement that we were just talking about, you would really have to be able to define terms and agree on them. So this is a big opening round. It is certainly going to be a wake-up call for other trading partners and very much so for businesses and investors.
Could be a massive opening round. Shep, appreciate the update. Mike Shepard there of Bloomberg down in Washington, D.C. in our nation's capital. Just moments ago, if you are just joining us, and welcome to the program. The Washington Post reporting the White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States. This according to 3 people familiar with the matter. There's an additional dimension to this story on the tax side that I think is worth highlighting, that the president's team is exploring using trillions of dollars in new import revenue for a tax dividend, Lisa, or refund.
So this would be the sweetener on the flip side of some of these tariffs that would be, as some people are saying, the worst case scenario in terms of the most maximalist in terms of tariffs. A big question here of the timeline of how hard it would be to get those through. And I will just say, bonds are still rallying on the margin, but not nearly as much as you'd expect if you think about some of the projections from Mark Zandi, from Parthenon, talking about the likelihood of recession and unemployment rising to as much as 7% by 2027.
Tobin Marcus of Wolf Research joins us now to extend the conversation. Tobin, good morning and welcome to the program. How about that? 20% on all imports. Now, this can change. As we always say on this program, I said just moments ago, situation's very, very fluid. But how does that stack up relative to what you're expecting for tomorrow?
Well, happy Liberation Day Eve to you as well, Jonathan. Look, that's certainly at the high end of the range that we've been contemplating. Even when you throw in gross value-added taxes into the calculations of these numbers, which are the real big thing that drives them higher, 20% as an average rate or a rate that applies to many or most of the countries that are being hit here, that's definitely at the high end of the range that we've been contemplating. I think even relative to a consensus among investors that's moved towards everyone expecting higher numbers tomorrow over the course of the past week or two, that would definitely be a surprise to the high end.
Right now, the Washington Post is saying this is just one proposal on the table. Tobin, do you get a sense that the White House has actually made up their mind yet?
By all accounts, they have not. It sure seems like deliberations are ongoing. As recently as this weekend, it seemed like there were multiple reports that the idea of a flat across the board universal tariff in that 20% range had resurfaced. I do think they're going to end up with more individualized country by country numbers in this reciprocal framework. But exactly where those numbers come down does still seem to be up in the air.
Is 20% here to stay if they go with that proposal, or is this the opening of a negotiation?
So at some level, I do think that this is the opening of a negotiation. Certainly, there will be negotiations. I fully expect that there will be talks with many of our biggest trading partners. And I think there's probably room for the numbers to come down somewhat. But I think I am more concerned than a lot of the sell side about the durability of these tariffs. And I think it's really notable that in the past week, you had both Trump and Peter Navarro talk about $600 billion a year in tariff revenue. A week before that, you had Lutnick talking about $1 trillion target for revenue from tariffs, as well as things like the new Trump Gold Card. Those are numbers that you can only achieve if you actually keep these tariffs in place, not briefly threaten them and then quickly negotiate them away. And I do think there's an aspiration to fundamentally redirect the global trade system. So, I think a lot of this is going to be here to stay. From a negotiation perspective, also, it's notable, if VATs are the thing driving this, value-added taxes, countries are not going to be able to negotiate those away. So let's talk about if they drop their tariff barriers, we'll drop ours. It doesn't really work that way if tariffs themselves are not the things driving these ostensibly reciprocal rates.
Tobin, how long would it take to pass some of these other sweetener proposals that could potentially offset the growth hit from these tariffs to the United States? I'm talking about certain tax rebates or tax cuts.
I think the tax bill is probably going to be enacted in a July type of time frame. Certainly, they are trying to get it done before the debt ceiling X date, because the plan in Congress at the moment is to include a debt ceiling increase in reconciliation to have that be the vehicle. So that would mean they need to get it done before probably roughly mid-August. So that late summer timeline is what we've been circling sometime in Q3. It will be certainly better news for markets than the tariffs have been, but I think from a scale perspective, what's currently on the table does not look like it comes close to fully offsetting the hit from the tariffs. Like, there are good things in there, both individually and in terms of corporate tax cuts on things like bonus depreciation, but it really is at a significantly smaller scale.
Hey, Tobin, appreciate your time and reaction to the breaking news. And happy Liberation Day Eve to you as well, sir. Tobin Marcus there of Wolf Research. Look, we've said it a few times already this morning. It's fluid. And that's a proposal. That proposal can change. We'll see what we get tomorrow and how people will respond to that. But the fact that equities aren't cratering maybe makes that proposal more likely than not.
Is that a starting place at a certain point? Because you're talking about negotiations. But to Tobin's point, how much room is there for negotiation? Can you get some sort of resolution if you have the threat of a whole host of different levies on trading partners?
Also, how difficult is a negotiation going to be when you're not just talking about tariffs vis-a-vis tariffs? They want non-tariff barriers to come down. They want to stop FX manipulation, which you can look at certain countries where the Treasury Secretary said that's a problem. They want to stop some countries providing cheap loans. There's a slew of issues they're going after here with these tariffs.
New quarter, same story. Equity futures on the S&P negative here by 0.25%. Up next on the program, the former Fed Vice Chair, Rich Clarida, as markets brace for Liberation Day. From New York, this is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Snapped a three-day losing streak in yesterday's session. Equity futures this morning, though, resumed declines. We're down across the board on the S&P by 1/3%. For the month of March, the worst month in 2.5 years. The worst month going back to 2022. With 3 hours to go until that cash open, let's get to your morning movers with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Newsmax up 11% here in the pre-market after climbing more than 700% yesterday in its market debut. Newsmax is a conservative media outlet, and the stock was apparently driven up yesterday by retail traders. We know the stock was one of the most traded on Fidelity's trading platform, and there was plenty of chatter about it on Reddit, where we know traders like to gather. Next up, we have shares of Tesla. Those are up nearly 2.5% here in the pre-market, despite the company posting a 37% sales drop in France. So why is the stock rising here? Well, it could be an oversold bounce. We know that Tesla fell 36% in the first quarter, or this news out of China that a Xiaomi EV with driver assistance crashed, killing 3 people. So calling into question the safety of their vehicles and potentially helping to boost Tesla in the country where we know it has struggled. And last up, we have J&J falling 3.6% here in the pre-market after a federal judge rejected its attempt to use bankruptcy to set up a fund to pay the women who say they got cancer using their baby powder. It's the 3rd time J&J has tried to pull this in court, but a judge for the 3rd time has said no. So the company will still need to face the tens of thousands of cases related to this. John?
Deeply, deeply uncomfortable story. Yahara, thank you. Appreciate the update. Sometimes you've got to bury your personal feelings on an issue, but something about that story, in fact, the obvious about that story is just absolutely nauseating.
That people used it for so long and got all of these cancer cases.
And you're attempting to go through the courts to avoid the claims that are being made?
So
I think it speaks for itself. I think everyone would be on the same page. We'll let the courts deal with this. On our radar this morning, a proposal to impose tariffs of around 20% on at least most imports to the United States. The Washington Post citing 3 people familiar with the matter. Trump is set to announce his tariffs at 3 p.m. Eastern time tomorrow.
So this looks like a maximalist approach when Trump is going after reciprocity with a number of countries. We heard from Scott Bessent yesterday, Treasury Secretary, saying this isn't just about tariffs. It's about other issues as well, like FX manipulation. My key question for the administration today, after seeing this report, would be, if this is the start of a negotiating, which it sounds like when you listen to some of the president's aides, if this is the start of negotiation, then where's the money left over to do the extras and the revenue raising that this story is also talking about? It goes on to say that they're also exploring the trillions of dollars in new import revenue. Well, the tariffs would have to stick to get those trillions of dollars to have a tax dividend or refund when it comes to tax rebates for the American people.
Just to give some perspective on what this would look like for the economy, Goldman Sachs economists now see a 1 in 3 chance of some sort of recession this year on the backs of some of these tariffs, and that assumed a tariff rate of 15%. A tariff rate of 20%, you have Mark Sandy over at Moody's, you've got EY Parthenon talking about a very high likelihood of recession this year, and potentially an unemployment rate that goes to 7% as soon as 2027. Key question is, how much does that hamper the ability of this to go through, given the fact that there are a lot of congressmen, particularly Republican congressmen, that are starting to push back and really express some concern.
The stagflationary mix and some of the forecasts as well is something we'll talk about in just a moment. Another update on another dimension of the trade effort. Commerce Secretary Howard Lutnick signaling he could withhold promised CHIP Act grants. Sources telling us here at Bloomberg the move comes as Lutnick pushes for companies in line for subsidies to expand their U.S. products.
So they want more production, especially when it comes to chips in America. They just don't want to go about it the way the Biden administration did. One issue politically is that this has strong bipartisan support, the CHIPS and Science Act. But yesterday, the president signed an executive order creating this office within the Commerce Department for companies that come here and build. They're going to facilitate the speed in which you can get actually shovels into the ground and create these massive, whatever, it's a chip factory and the likes. They're using a different approach, a different carrot and stick approach when it comes to wanting to make sure they are bringing back manufacturing to the U.S.
So Howard Lutnick, according to this reporting, said that this is benefit of the deal. And I just wonder how this is going to go through the system if you have a deal and then you renegotiate the deal after making that deal without necessarily changing some of the parameters. That is a real question. How do they do that? And then how do they sort of go forward with other deals and have the validity, understanding that they'll stick?
We might find out. In the next few months, at least, anyway. Wanted to finish on this story. Microsoft-backed AI firm Builder AI lowering its sales figures and hiring auditors to examine its last 2 years of accounts. In a major setback for the company, the CEO saying, quote, "We need to do a little bit of work, making sure we get our house in order." The hits keep coming for this part of the tech universe.
That's the right way of framing this. How much are the golden geese we've been looking at really just tin painted with some sort of gold patina? And this is sort of the question as we talk about the potential for some sort of AI bubble. As you start to see malfeasance or some sort of auditing issues, hallmarks of a moment where you just saw the NASDAQ lose 8.3% in a quarter.
It's not been a good week. It's not been a good 3 months for those particular stocks. Let's get to it then. Investors looking ahead to a big week of data leading up to the payrolls report. Former Fed Vice Chair Richard Clouder writing, consensus look too sanguine on the economic data. We see downside risk to 140 consensus for non-farm payrolls, and we see upside risk to the unemployment rate relative to consensus. I'm pleased to say that Richard joins us around the table. Rich, good to see you.
As always.
Good morning. I think we've got to start with that Washington Post proposal. What on earth does the Federal Reserve do if they come out tomorrow and unveil 20% tariffs on most imports?
Well, as I think you mentioned, it is a maximalist approach, and at least right now, if this reporting is correct, it doesn't look like it's so much country by country. Maybe this is the floor, but yeah, no, this is a much bigger hit to tariffs, I think, than most people were thinking, presumably the Fed even a couple of months ago. What does it mean for the Fed? You know, I think Jay Powell at the March meeting, at least to me, signaled they're happy to basically sit on the sidelines. I don't see them acting preemptively to cut rates because they may be worried about a downturn. And so what that means is that it will take tangible data of a slowdown in payrolls, maybe a big pop in unemployment. So I see the Fed on the sidelines until the macro data really turns.
How long can they wait on the sidelines if there's damage being done just off the fact that there's so much uncertainty, and potentially, if this is an opening gamut, that uncertainty can persist for the next few months?
Anne-Marie, I think it's an excellent point because we saw a preview of this in 2019. We had a lot of trade policy uncertainty, not very many actual tariffs that got put in place. Uncertainty is a headwind to growth. I think it's already slowing the economy. I don't think the uncertainty is going to be resolved tomorrow, especially if there's a negotiation as part of this. And so it's a headwind to growth. And I think the balance at the Fed right now is because of the stagflation threat, that inflation will be going up at least for a while and the economy is slowing. I think it makes the decision one that's a tough one, but I do think that on balance, they're on the sidelines until the data really does turn.
So there's a question of what they plan to communicate, how they plan to use their tool of talk. And that seems like a new trend, or Jay Powell speaks. After every non-farm payrolls report, he's going to be speaking yet again on Friday voluntarily. What is the message that he's looking to convey?
My sense is he will not wander too far away from the press conference a couple of weeks ago where he really did not really embrace the SEP projections of 2 cuts. He basically said we had to write something down. And so I don't really expect him to move beyond that they're really in a wait and see, excuse me, a wait and see mode when it comes to the data. But importantly, I don't see them acting preemptively as the Powell Fed did when I was there in 2019. We cut rates because the economy was slowing on the uncertainty, but inflation was 1.5%. It wasn't close to 3%. So it's a different set of conditions now.
Could you just give us a sense of how much you've increased your chance of true stagflationary-like environments if you do get some sort of maximalist tariff proposal like what we're hearing from the Washington Post this morning?
Well, I think we already have at least a whiff of stagflation right now. Inflation mechanically will be moving up with the tariffs. Also, we're seeing some evidence, Lisa, that even goods prices before the tariffs go into play, goods prices are going up. So I think slower growth, higher prices, we have a whiff of stagflation. The real question for the Fed is this 6 months, or is this really becoming the new story for the next couple of years? And I think, again, it's too soon to tell because this could come down to the art of the deal eventually.
Were you surprised to hear the T word make a comeback in the news conference? Transitory.
Well, I think a reporter did put that in the phrase. Look, as you know, I've said on your air, I was a charter member of Team Transitory, so I know the history on that. The textbook says the Fed should look through it, but I think they've correctly been reminding folks that only goes through if you're convinced, as Jay Powell, that inflation expectations are well anchored. And unfortunately, the UMISH data is going in the wrong direction right now.
We're conditioned by experience. Do you think they'll be conditioned by the experience of 21,
oh, yeah,
22?
Absolutely. Well, the combination of the experience and the fact is even before the tariff discussion, core inflation was running at about 2.8%. It wasn't 2 or 1.5. So it's that experience plus the initial conditions coming into the year.
How much do you get the sense that there's real division right now in the Federal Reserve? That there's a sense from some people that they need to prioritize inflation and the fight there, and they think it's overly cute to really talk about transitory or talk about the likelihood that this tariff wave is like what we saw back in 2018?
I think there probably is a range of views. In particular, you know, the president of the St. Louis Fed has staked out in a recent comment that it would be risky for the Fed to put too much on transitory, and other folks, including Governor Waller, have reminded them of that analysis. I don't see a big split right now, and interestingly enough, I don't even see a split on the wisdom of perhaps acting preemptively to cut rates as we did in 2019. I think they're pretty aligned on the view that they're just going to sit tight, and with the potential cost that the data would have to turn south to get them to act.
Given that, is the Fed put as we've known it not in existence anymore?
There is a Fed put, but it will be a put that only is deployed after the data has turned. There's not a 2019 example where the Powell Fed cut rates 75 basis points because of concerns that trade policy uncertainty might push the economy lower.
Is that a commitment to being late?
It's a commitment to not being early. I'll put it that way.
Is that the greater risk then?
I think it is. Yeah, and I think we've discussed that before. Yes, of course.
Thoughtful stuff, Rich, as always. The former Fed Vice Chair, Rich Clouder, on some of the risks facing this Federal Reserve, going into what could be a big day tomorrow, the prospect of some big tariffs.
This ain't your mother's Fed put, that's all I can say. If they're promising to be late, they're not going to come in and jawbone a market or be able to do that. It just shows how different we are right now and how different the setup is than in 2018, both economically and just with a set of tools from policymakers that potentially could change the scene.
2018, and Rich said it. You were dealing with 1.5, 1.8 inflation level. It was much easier for the Fed to act and really consider tariffs as transitory, a one-time hit. That's very different this time around.
Different starting point, that's for sure. Equities this morning kicking off Q2, negative by a third of 1% on the S&P, with an update on stories elsewhere. Let's get your Bloomberg brief with Yahara Hacker. Say, Yahara.
Hi, John. White House aides have drafted a proposal that would impose roughly 20% tariffs on most imports into the U.S. The Washington Post reporting, citing 3 people familiar with the matter. The report comes ahead of President Trump's Rose Garden news conference on tariffs set for 3 p.m. Eastern tomorrow. Meanwhile, Marine Le Pen has criticized the court ruling barring her from running for elected office for 5 years. In an interview on French TV, Le Pen, who was convicted of embezzlement, claimed that the decision was politically motivated. In addition to the electoral ban, she was sentenced to 2 years in prison. And SoftBank Group is said to be seeking a loan of as much as $16.5 billion to help fund AI investments in the U.S. Sources telling Bloomberg talks with banks are in the early stages for a bridge loan with a time frame of about 12 months. We're told the money may help SoftBank lead a $40 billion funding round for OpenAI. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira a little bit later. Up next on the program, eroding dollar dominance.
The tariffs are stagflationary. That's really what's knocked the dollar off its perch. If you recall, we started this year off with the U.S. running at full speed. Everyone bullish on U.S. equities, the U.S. dollar, and really we kind of hit a wall.
The dollar definitely hit a wall. Up next on the program, George Saravelis of Deutsche Bank from New York. You're watching Bloomberg TV.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from New York City, hello Q2. Equity futures right now, negative 1/3% on the S&P. We're down by 1/4% on the Nasdaq 100. Earlier this hour, the Washington Post indicating the White House has drafted a proposal to impose tariffs of around 20% on at least most imports to the United States?
The maximalist approach that a lot of people have projected would do potentially the most disruption to the U.S. economy. The question that we've been talking about all morning, is this the beginning or is this the end point in terms of where these negotiations are going?
Under surveillance this morning, eroding dollar dominance.
The tariffs are stagflationary. They have an inflationary effect, but they also have a deflationary effect. That's really what's knocked the dollar off its perch. If you recall, we started this year off with the U.S. running at full speed. That went bullish on U.S. equities, the U.S. dollar, and really we kind of hit a wall. And it's really just due to this policy uncertainty.
So here's the latest this morning. The U.S. dollar posting the worst month going back to November 2022 as policy uncertainty weighs on the currency. To discuss, George Saravelis of Deutsche Bank joins us now for more. George, welcome to the program. I think the big question we were trying to answer in the first quarter, and you might not get an answer for a while, are we at risk of losing safe haven status for the U.S. dollar in this FX market? How are you and the team thinking about that question at the moment?
Hi, John. So it's obviously a very big question, and there are many moving parts to what we consider the safe haven aspect of the dollar. I would say at the core of dollar allocations at the end of the day has just been U.S. outperformance. The U.S. has been growing more than the rest of the world. And in all these global shocks we've seen, if you think about COVID, if you think about the Russia-Ukraine crisis, the U.S. has outperformed. It's been less exposed. So if you own U.S. assets unhedged, the dollar's tended to rally with these shocks. So it served as the perfect safe haven, so to speak. But now you're seeing a shock that's internally generated inside the U.S. It's leading to U.S. underperformance, and you're seeing U.S. assets underperform and the dollar weakening at the same time. So I think that is the first component of potentially an unwind to this dollar exceptionalism status that has been around for the last decade or so.
So, George, that's one element, as you say, of the story, risk assets underperforming. There's a more important one, I think. When things get bad, are we still buying U.S. Treasuries? Any reason to believe that's going to change?
So that goes into the second, more structural, more difficult question. If you go back to why does the market buy Treasuries, it's a deep market, it's a liquid market, it's a safe market. The U.S. is the Western world's security guarantor, it has secure property rights, and I think the challenge over the last few weeks that we see many investors perceiving and the question asking is, when there is a discussion around Greenland, when there are discussions around the broader security architecture, can that position be taken for granted of U.S. Treasuries? I think it's obviously a very big question, but we are undergoing transformations to international relations and geopolitics that we haven't seen for many, many decades, and I think it's a valid question to ask. It is definitely being asked in client meetings and conversations we're attending.
George, we've been talking about this for quite a while. When does the dollar lose its haven status? And people say, well, it might lose its sheen a little bit in the near term, but it won't necessarily lose its status overnight. There might be sort of a slow bleed over the next decade or two. Is that kind of how you see things?
I think if you look at the history of so-called reserve status and the pound sterling used to hold that role, now it's the US, it is many different things coming together all at the same time. And by extension, they're not going to evaporate overnight. I would have sympathy with that. But I would say over time, if various things add up, you do see the ingredients for potentially a lower allocation into dollar assets. I would say the starting point is always going to be the cyclical position of the US. The reason the dollar has done so well is it's had a much more superior cyclical economic outlook compared to everyone else. Now, if that's deteriorating, you naturally see the dollar weakening for cyclical reasons. But I think in the background, all these other changes in the conversation that are taking place on the geopolitical front, in terms of security guarantees, these things do also matter for a currency as for a currency's reserve status. We've definitely seen it through history, and there's also plenty of academic papers that have been written on the topic.
So a number of people have said to me, gold is telling us something. Listen to gold. Gold just posted its best quarterly performance since 1986. Other people say, yeah, maybe, but it also is a perfect hedge for a whole host of different trends that a lot of people are piling into. From your perspective, how much are you listening to signals from gold, and what are they?
So remember, the gold has been going up for the last 5 to 10 years, even as the dollar's been going up at the same time. So to your point, there's been other things that have been supporting gold. But I do think there is an element of that, of diversification away from the dollar. What we look at is not just one thing, gold being one of those, but the broader picture. So we're looking at the dollar equity correlation, which is starting to change. I think monitoring term premium in US Treasuries, which is the genuine measure of risk, and how that's shifting versus other bond markets. Are we seeing an elevation of term premium? That's also important. The bond equity correlation itself. Could we be in an environment where bonds are refusing to rally even as the market is pricing much slower growth? I think it's all these components that will start giving us a market signal around some of the more medium-term shifts in relative portfolio allocation.
As we look ahead to tomorrow and the tariffs that are going to be announced by the president, do you think all the headlines are baked into the dollar? How do you expect the dollar to react tomorrow if we get, say, a 20% tariff rate on most countries?
That's a great question. It's one that's preoccupied the market through the entirety of the year. I would say this 20% headline we've got from the Washington Post, we got hints of that from Peter Navarro over the weekend, where he talked about 600 billion revenue on an annual basis. If you apply that to a 3 trillion import tariff, it's 3 trillion import base, it's roughly a 20% effective tariff rate. So I would say by tomorrow, that 20% number should be generally baked in. The key question, of course, is why isn't the dollar rallying a lot more than what people were expecting at the start of the year? And I think one point goes to just this broader downgrade of US expectations. But there's a second one, which I think bears a lot of, is worth emphasizing, which is fiscal activism outside of the US. And what we're seeing in Europe, we saw it by the German announcements. For example, if you think about the Canadian election, which is soon to be concluded, I think it's very likely that you will see a lot of fiscal activism outside of the US to offset these tariffs. By extension, the impact becomes less asymmetric if the rest of the world is able to support the global economy. While in the US, there's still a very large debate on where the fiscal stance is going with these tax negotiations still taking place.
We're trying to figure that out too. George, appreciate the input this morning. Thank you, sir. George Saravelis there of Deutsche Bank. Trying to figure this out. The Treasury Secretary Scott Bessent speaking in the last 24 hours or so. No taxes on tips, no tax on Social Security. The list goes on and on. No tax on overtime. We're going to make purchasing an American car tax deductible again. So their list of demands for Congress still building.
It feels like the Oprah Winfrey election is now becoming the Oprah Winfrey administration because they keep adding to the list of what potentially could be these sweeteners and these tax cuts. The issue is they have to get everyone on board in a very slim majority to even sign up for the extension so far of TCJA, let alone potentially maybe one of these add-ons when it comes to tax cuts. No one thinks they're going to get this entire list.
This is a broader restructuring of how the United States does business, and they're trying to draw back manufacturing to the U.S. and make things cheaper on the flip side, to use these tariffs truly as a tax. The issue is sequencing, and the issue is timing. Can they do this so quickly without massive disruptions to a massive economy?
We've said repeatedly on this program over the last several weeks, this is the strategic anchor of the equity market bulls. They still believe the overall policy mix, the more complete platform, is still pro-risk and pro-growth. And a big dimension of that is the tax plan. Some details of that coming from Secretary Bessent in the last 24 hours or so. Up next on the program, Ed Yardeni of Yardeni Research, alongside Bloomberg's Laura Davison, Francisco Blanch of Bank of America on a big call for gold. And we'll catch up with John Bilton of JP Morgan Asset Management from New York City. The second hour of Bloomberg Surveillance, up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read.
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
April 2nd at midnight, lots of tariffs start going on. So it's going to be a really long day.
We don't expect that large tariffs on Canada and Mexico will stay.
I don't know that I'd look for just broad-based universal tariffs. I think it's a negotiation point.
I think anytime Trump is threatening tariffs on a product, there really isn't much negotiation to be had.
What we know about tariffs is tariffs increase costs. How much they increase consumer prices remains to be seen.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Welcome to the program, everybody, with your equity market negative 1/3% on the S&P 500. On the Nasdaq 100, a little bit softer as well. We're down by about 1/4%, down 1/10 on the Russell. Equities a little bit softer to kick off Q2. Lots of economic data through the week. It starts later on this morning with the ISM and JOLTS ISM manufacturing before we get, of course, ADP, jobless claims and payrolls later on in the week. Before we get there, of course, the big one. The big one's 24 hours away. A ton of tariffs set to come from the President of the United States, and the latest indication from the Washington Post is it could be very big. This is their reporting. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States.
And that would be the maximalist approach that a lot of people have been mapping out and above where Goldman Sachs was looking for still a 1 in 3 chance of a recession this year. Key question is it a negotiating jumping off point? Is that something that you can do if you invoke the ire of some of your trading partners at the same time? Key issue for a lot of people is the downgrades are happening before we even get some of these tariffs or the details because no one is expecting the uncertainty to go away.
Is it a start of negotiation or is it the start of new revenue raisers that in this report talks about the fact that maybe then you can have a tax dividend or refund? It depends who you ask in the administration. I look at this story and I say this sounds like a proposal that potentially came off the likes of Peter Navarro's desk. And then I hear from the Treasury Secretary last night saying everyone will have the opportunity after the president's announcement, meeting other trading partners, to lower their tariffs, saying it's a negotiation. The situation, I think, is still fluid to this day, depending on what the president is going to do tomorrow in the Rose Garden.
Some of these ideas are very incompatible, highly contradictory, if you will. Just think about it. At the same time they're saying that they're going to raise all this money from tariffs, they're also saying all the money will be spent domestically instead. Can you do both? At the same time they say it's going to be a revenue raiser, they also say you can negotiate things. Can you do both?
No, because essentially if you want to raise revenues, they've got to stick. If you want to negotiate, you've got to take them off. The revenues don't come in. People are trying to count it up and saying, actually, my head is spinning. I'm not going to even try. Let's wait to see what they propose. Either way, that is the reason why people are downgrading their expectations, because the uncertainty is not going away. And it's unlikely that this is going to come into crystal clear focus tomorrow in the Rose Garden at 3 p.m.
I imagine how the president might see it is starting a maximalist approach, very on brand for President Trump, who wants to be a deal maker, see who you can make deals with, and then the ones that you can't, then those will be the revenue raisers. But then it's very difficult to put figures like $6 trillion on this kind of tariff plan if you're willing to make those deals along the way.
We're desperate for clarity. Are we going to get it? Lisa, that's essentially what you're asking. This is the reaction we've had from Wall Street so far. Max Kendler, tariff noise likely to extend beyond the 2nd of April. Julian Emanuel of Evercore, a peak, not an end to the uncertainty. And you talked about what we heard from Mike Wilson of Morgan Stanley, not a clearing event for him and the team.
Yeah, the reciprocal tariff announcement should offer some incremental clarity, but it's likely a stepping stone for further tariff negotiations. That was Mike Wilson. The fact that David Kostin of Goldman Sachs downgraded his expectation for the S&P 500 year-end target twice in 1 month with possible downside ahead gives you a sense of how quickly this is moving, and it is moving in one direction, even without some of those clarifying moments that we're expecting to get.
In a moment, we'll talk to another man who did just the same, Ed Yardeni of Yardeni Research, on another equity downgrade. Francisco Blanche of Bank of America on gold's record-breaking rally. He'll join us later. And then we'll catch up with John Bilton of JP Morgan Asset Management on the countdown to Liberation Day. We begin this hour with stocks sliding after their worst quarter in nearly 3 years. Ed Yardeni of Yardeni Research cutting his S&P 500 price target to 6K from 6,400, writing the expected fallout from Trump 2.0's reign of tariffs undercuts our former bullishness and dims the prospects of our base case roaring 2020s scenario. Ed joins us now for more. Ed, good morning. Good to see you. Second change for you in a number of weeks.
I hope you're not looking for clarity for me, because I'm struggling with all the confusing information coming out of Washington. As you said, you're getting different messages from different people in the administration, and at the end of the day, it'll all depend on what the president concludes he wants to do that day, and he could change his mind again.
How much damage do you think the accumulating uncertainty is doing already to the underlying economy?
Well, if you look at all the soft data, which is very much forward-looking, it's not looking good. The current data, the present data, looks pretty good. The labor market is doing fine. I think we had some really cold weather in January and February that depressed consumer spending. So I think we're going to have this really bizarre scenario where the first quarter is, we got real GDP up 1%. I know others have it even lower than that. Then it could be something like 3% in the second quarter, because you could really have a nice rebound in consumer spending, and consumers could be running to buy cars before the prices go up, which will be kind of another possibility. And then in the second half of the year, we could have stagflation, where the economy in a growth recession, maybe very little growth, if any, maybe even a shallow recession. And so that's the way I'm kind of seeing this thing playing out in terms of its impact on the economy.
And right now, you and the market are focusing on the reign of tariffs. What happens when we're focusing every day on this potential extension of TCJA and other tax cuts that we may get? And they're focused on having this done before September. Yeah, well, it's going to be, if you think it's messy now, it's going to get even messier if you, on top of the whole tariff issue, which isn't going to go away just because they announce what they mean by reciprocal tariffs. I mean, the 20% number that's out there basically suggests that now the president is looking to raise revenues. Navarro is saying $6 trillion is what he claims that this could raise. And now, on top of that, we start to try to extend the tax cuts. And an extension of tax cuts, it's not stimulative. It'll be very negative if they don't get the tax cuts extended. Well, the Treasury Secretary last night is talking about that they want to get done no tax on tips, no tax on Social Security, no tax on overtime, and also purchasing an American car, making that tax deductible again. If you have even one of those sweeteners, would that be bullish for the market?
Well, I don't know that that'll make it that much easier to get it through Congress. I mean, it is like a volatile situation in Congress. The margin that the Republicans have is very narrow, and the Republicans don't always stay united. So no, I don't know that those particular issues are going to be market moving at all.
At a certain point, if people are talking about the likelihood of recession, what gives you the idea that this is going to be more stagflationary than just traditionally recessionary? Well,
the thing that we all have to worry about, of course, is the consumer, and the consumer confidence numbers have all been depressed. The animal spirits that we all were kind of counting on to keep the stock market going and consumers going is kind of fizzled away here. And a lot of it has to do, obviously, with the kind of disappointment. Consumers were expecting that the administration would focus on somehow lowering prices, and instead now we will have higher auto prices if we're going to have a 20% permanent tariff on autos. And of course, if we have a 20% tariff across the board, prices are going to go up. So that's disconcerting.
I guess that the reason why I ask this is because, to Neil Dutta's point, a one-time price adjustment, but if you have less demand, you'd imagine that that would be a one-time price adjustment, and then you won't be able to have the ability to really raise that, especially at a time where potentially the labor market could come under some stress. So what is giving people the sense that this time is different, that there could be a prolonged inflationary type of bent that raises questions about U.S. Treasuries, that raises questions about what the Fed can do?
Sure. I mean, it's not likely to be a one-month event where, you raise the tariff and the CPI goes up to one level and it's a bad month for the CPI and then it comes back down. As a matter of fact, we raised our inflation outlook for the rest of the year from 2 to 3% to 3 to 4%. I think it's going to show up that quickly. And I think it's not going to be that transitory. It's not going to be 1 or 2 months. It's going to last for several months. And again, this is an ongoing dynamic process. We don't know whether more tariffs will be added or reduced. It's just kind of confusing, but I think companies have already anticipated that their costs are going to go up. Certainly, if you're in manufacturing, your costs are going to go up from all the parts. And as a result of that, we're seeing price kind of forward indicators of inflation showing that there's a problem. And so that the regional business surveys, for example, are also showing that prices paid are going up.
Begs the question, Ed, why do you think stocks are going higher by year end?
Well, I'm kind of counting on the market to look forward as it typically does, and I'm kind of hoping that all these issues get somewhat resolved by the end of the year, and I think the market starts to look ahead into 2026. I haven't given up on my roaring 2020 scenario.
Sticking with it.
I'm sticking with it. I think it's got temporarily waylaid by all those tariff issues and all these policy balls that are up in the air. But I think I guess my underlying thesis is look how well the economy has done in the past, despite Washington. And so I'm hoping that'll work again.
We've continued to underestimate the performance of this economy over the last several years. That's certainly been a feature.
Which is the reason why a lot of people are saying that actually you could see gains and you could actually see ongoing inflation. Because if you are underestimating the power of the consumer, they will be able to absorb some of this and they will keep spending. And companies know this and know that they don't have a sense of that price target as much as pre-pandemic.
Equities right now on the S&P negative by 0.4%, just a little bit softer. Ed Yardeni of Yardeni Research will be sticking with us. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. European Commission President Ursula von der Leyen says the bloc is ready to retaliate to protect itself against President Trump's tariffs if needed. The EU is considering a range of options, including using its anti-coercion instrument to restrict trade and services, intellectual property rights, and access to public procurement. Meanwhile, Huawei posted its first quarterly net loss in years after U.S. sanctions forced it to spend aggressively on R&D. The Chinese tech giant says its net loss in the December quarter stood at around $41 million. Huawei, however, did report gains in its smartphone business, cloud computing arm, and its core telecom unit. And the Trump administration is threatening to scrutinize billions of dollars in federal funding for Harvard University as part of efforts to combat anti-Semitism on college campuses. The review includes nearly $9 billion in grants and more than $250 million in contracts. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, President Trump's big tariff push.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs.
We'll get the latest down in Washington in just a moment with Bloomberg's Laura Davidson and more from Ed Yardeni of Yardeni Research from New York City. This is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Equity futures softer across the board as we begin Q2. We're down by 0.4% on the S&P, a little bit lower as well on the Nasdaq, down by 0.4% also after snapping a three-day slide in yesterday's session to close out Q1. Q1 closed with an ugly month of March. March, the worst month in more than 2 years. On a Russell, was softer by 0.2%. Under surveillance this morning, President Trump's big tariff push.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind. I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs.
So here's the latest this morning. White House aides drafting a proposal to impose 20% tariffs on most U.S. imports. The Washington Post citing 3 people familiar with the matter. President Donald Trump is set to unveil details of his tariff agenda from the White House Rose Garden tomorrow afternoon. Joining us now for more is Bloomberg's Laura Davidson. So, Laura, welcome back to the program. Help us put it all together. What's the latest this morning?
So the latest is that Trump is essentially reverting to what his campaign trail proposal was, which is a 20% tariff on all goods coming into the country. This would be on top of the other tariffs on steel and aluminum and autos that he's already unveiled. So for some countries, for example, South Korea with a lot of car imports, that would be 20% plus 25% for a whopping 45% tariff. This is all not finalized yet. This is coming out tomorrow at 3 o'clock. The president is planning a Rose Garden ceremony to unveil all of these. But even in these final hours. His aides are still detailing this plan, and we still are hearing from CEOs who are going to the White House to lobby for some sort of exemptions, leniency, or even perhaps a delay. Laura, it doesn't sound like a decision has been made, does it?
No, and this is really, you know, how Trump frequently makes decisions. He has a bunch of people coming to him, a bunch of ideas, and in the final hours he will make a call here. Of course, this is a very complicated plan, potentially, how he originally conceived it as a reciprocal tariff plan with a different tariff rate for every country. What we're seeing here is his aides sort of in the final days saying, look, we don't have time, we don't have agreement, we need to move forward with a plan, and this is the simplest route.
And Laura, from here, can we get on to taxes? We heard from Secretary Besant, the Treasury Secretary Scott Bessent, in the last 24 hours, who said no tax on tips, no tax on Social Security, no tax on overtime, and the list goes on and on. How quickly can we move towards getting that passed?
So the Senate is moving today to make some steps. They are going to unveil their budget resolution. They hope to pass that later this week. That really unlocks the process where the House and Senate can start negotiating the details over this tax plan. You know, we've heard from the Senate Majority Leader John Thune, House Speaker Mike Johnson. They want to get this done by the end of April or the end of May. That's a really ambitious goal. But you know, the real deadline they're facing right now is sometime in August because this bill will also include a debt ceiling increase, and that's when forecasters say we are likely to need an increase in the U.S. borrowing limit.
Hey, Laura, appreciate the update. Laura Davison down in the nation's capital in Washington, D.C. That has the potential to change this conversation, but it could take months and not weeks.
It could take months and weeks. And also what I think is interesting, we talked about this last week, the fact that they're now putting in the X date, the idea that you have to have reconciliation done in time to make sure you can lift the debt ceiling, means that they're putting a deadline to get these tax extension done in time before September, when potentially we might get this X date. They think is middle of the summer. So that's the administration really trying to drive this home when it comes to the competing forces in Congress.
Still with us around the table here in New York, Ed Yardeni of Yardeni Research. Ed, let's continue the conversation. Have you ever seen sentiment this bad, this weak, outside of a recession in the United States? You've been doing this a long time, have you?
Yeah. Well, that's my concern, is we could see sentiment push us into a recession. And of course, the stock market could do the same. I've got a lot of friends who've retired or are retiring, and they were looking forward to having a pretty good retirement because their assets were all going up. And now all of a sudden they see that their assets are going down on the stock side, and that's got them nervous. And I think the baby boomers have been actually keeping the economy growing in the face of a very significant tightening of monetary policy. The consumer kept going.
If you ignore the headlines, though, and you look at the Trump agenda more holistically, tax cuts, deregulation, and tariffs.
Looks, well, the first two look good. Well, it's a mishmash, you know. Everybody recognized all along that it was a combination of policies that could be restrictive and slow the economy down, and policies that could be stimulative. In Trump 1.0, they started out with the tax cuts, and then they went to tariffs. Here they started with tariffs, which has got everybody confused, and sentiment is down, and the stock market is down. And right now we're seeing the restrictive aspect of their policy. Deregulation is something that's probably ongoing. I think there's things going on in the energy field, for example, that certainly can be characterized as deregulation, but they don't make the kind of headlines that affect consumer sentiment, business sentiment, and so on. So I think it's kind of more of a long-term effect, whereas the short-term effects are weighing on the economy.
Where does this leave the bond vigilantes, who you thought were being resurrected not so long ago, and all of a sudden are kind of mired between recessionary fears and a budget that may or may not be expanded?
Well, I think they're confused like everybody else. I think the one area where there are a few areas where the Trump policies have been very, very successful. Shutting the border down has been obviously a big success so far. But the other thing is the tariffs have actually forced the Chinese to stimulate their economy, forced the Germans to stimulate their economies, and their bond yields have gone up, and the bond market is a global bond market, so it's helping to actually keep our bond yield from falling. I think if it wasn't for that, the bond yield might have actually come down some more. But meanwhile, the bond market is sort of on hold here, waiting to see what the Doge Committee delivers. Every single day there's some announcement of big cuts in the spending that they're able to come up with. But the reality is we don't know what the final number will be.
Ed, are you convinced by the potential for Doge to do something big?
Well, you know, day by day, it sounds like they're uncovering all sorts of amazing excesses, but I'd like to see what the final number is of what it actually adds up to. And You know, relative to the size of the deficit, relative to the size of outlays, it could unfortunately turn out to be a drop in the bucket. I mean, it would be wonderful. I mean, look, if they come up with $100 billion in cuts and you multiply that by 10, because that's the way we usually look at the deficit, $1 trillion is real money.
Michael Hanna of Bank of America wrote recently in the past few weeks that this market has been driven by Doge and DeepSeek and not tariffs. Can we talk about that a little bit more? When you go through some of these big names in Q1, talking about mega cap tech, when you talk about retirement, we're depending on these names performing and driving this S&P 500 higher. NVIDIA, Google, losing a fifth of their value in the first quarter. Tesla, a third. What's happening to big tech in America?
Well, what's interesting is, you know, big tech is to a large extent a Magnificent Seven. What's interesting is that we can look at there are ways to look at the S&P 493, and they've actually been flat so far this year. So all of the damage really has been in tech, and particularly in the Magnificent Seven. And I think you're right. A lot of it is people are kind of questioning the AI story. I don't think this is .com. I don't think this is the tech wreck that we had back in 2000. But I think some of the valuation hype or air has come out of these stocks, and that's another reason why I've lowered my numbers. I don't think we're going to go back to 22 multiple on the overall S&P 500 or a 30 multiple on the Magnificent Seven. It's already down to under 25.
Is this not necessarily the bubble bursting, but the bubble bursting in the sense that it really was a multiple story, not necessarily a tech story? Or can you see that maybe this is actually having to do with the fact that in China, they're making real inroads, and no longer is the U.S. so exceptional when it comes to some of the technological innovation as well?
Well, I think when it comes to AI, there's nothing keeping China or anybody else from coming up with innovations in that area. I think at the end of the day, AI is going to be a great productivity booster for the users of the technology. I think there's going to be so much competition to actually produce the large language models that, you know, the Chinese are basically giving it away, so that really reduces the value of all that money that's being spent. And I think that's where the issue is coming in the market, is people are questioning whether the hyperscalers are really going to be spending all that money on data centers, and data center stocks have taken quite a hit. But I think you're right. I think the valuation really depended on a notion. It really depended on a roaring 2020 story. It depended on the idea that the economy wasn't going to have a recession, but this tariff thing really has changed that.
Let's see if we can get back on course. Ed, it's good to see you.
Thank you.
Appreciate your time. It's great to see you in person too. Ed Giardini there of Giardini Research, breaking things down. What's worked so far this year? Chinese tech, part of that story. Upending the US tech story at the start of the year with the DeepSeek revelation. What's working elsewhere? European industrials, financials. That capital sucked into Europe on the prospect of more fiscal stimulus, just upending the US trade over the past few months.
There were two prongs to this, and Stuart Kaiser was talking about that. On one hand, you had the fiscal exceptionalism of some of the expansion of the U.S. balance sheet. On the other hand, you had tech exceptionalism, both prongs being challenged on two different fronts, both with cutbacks at the federal level as well as some of the challenges that we've seen over in China.
If you are just joining us, welcome to the program. Big challenge in the next 24 hours, expecting some major tariffs from the President of the United States. They will be unveiled in the Rose Garden tomorrow at the White House, we're told, at 3 p.m. Eastern Time. Going into it, equities a little bit softer. We're down by 0.4% on the S&P 500. In the bond market, yields have been lower. They stay lower. We're down 5 basis points on a 10-year this morning to about 416. At the front end of the curve, the 2-year down 3 to about 386. Up next on the program, a record-breaking rally for gold. Why gold can go even higher. Francisco Blanch of Bank of America joins us next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's get you some price action. Equities right now near session lows, negative 0.5% on the S&P 500 after snapping a three-day slide and a big decline this time yesterday morning by the time we got to a close. On the Nasdaq 100, we are negative by 0.4%. The Russell softer by 0.3%. The Washington Post reporting the prospect of 20% tariffs on most U.S. imports. We'll get to that story in just a moment. In response to that, that's your equity picture. Here's the bond market story. 2-year, 10-year and 30-year bond yield lower across the board. We're down by 3 basis points to the front end to 385. 10s are down 5 to 415. Call it 416. And the headline of the morning, off air, Ed Jardini headed towards the door, throws this one out there. He's got gold at 4K year end. Did he say 5K year end next year?
That's what he said.
Wow.
And he's talking about the potential for people to continue structurally buying gold, both as a precious metal, but also as a hedge to volatility and potentially to the dollar.
All-time highs. We're up again this morning. More on gold in just a moment. We're 2 hours away from the cash open. Here's your morning movers with Yahara Hacker. Say Yahara.
Hi, John. We start with PVH shares soaring in the pre-market, up 15%. And while PVH might seem unfamiliar, it's the company behind well-known brands like Calvin Klein and Tommy Hilfiger. Well, the company gave a surprisingly strong forecast, impressing investors at a time when we know other apparel companies have issued warnings about the consumer and tariffs and bringing down their forecast. Next up, we have shares of Live Nation. Those are falling nearly 1.5% after President Trump signed an executive order cracking down on ticket scalping and those pesky fees that make attending live events more expensive. And at the president's side during the announcement was Kid Rock, who called out Ticketmaster, which is part of Live Nation. He accused it of profiting each time a ticket was sold and resold. And last up, we have Southwest Airlines. Those shares are falling nearly 3% after Jefferies downgraded the stock to underperform. The analyst we know well, Sheila Cayugo, is expecting softness during the summer months. She says swelling macro uncertainty will weigh on corporate and consumer sentiment. And in this note, she also says she expects Southwest, American Airlines, and Air Canada will have to cut their 2025 outlooks. John?
Tough few months for the airlines, that's for sure. Yahara, thank you. More from Yahara later this hour. On our radar this morning, our top story, a proposal to impose tariffs of around 20% on at least most imports to the United States. The Washington Post citing 3 people familiar with the matter. Trump is set to announce his tariffs at 3 p.m. Eastern tomorrow.
What I think we've been hearing a lot this morning, though, the situation is still fluid. This is one proposal, this maximalist approach. What I find interesting is what the Treasury Secretary said yesterday. Then people will be able to line up and maybe lower their tariff barriers, AKA that leads into negotiation. There is something important happening today, and there's a question on whether or not it's going to be leaked or presented to the press as well. Jamieson Greer is going to go to the president, the USTR ambassador, the trade representative, with the report the president asked when he walked into the Oval Office day 1 in January. And that's to look at the trade imbalances for all these countries. Depending on what's in that report, that could dictate what we see tomorrow out of the Rose Garden.
Just an idea of what's going to be happening behind the scenes through the next 24 hours or so. A lot of lobbying as well. This as we talk about US automakers making a last-ditch effort to push back on tariffs set to take effect this week. According to people familiar with the matter, telling Bloomberg, Ford, GM and Stellantis are pressing the White House for exemptions on low-cost car components.
And I think maybe they've got a chance because this was something that was inserted into the proposal late in some of the negotiations, and this is their understanding. The issue here is how do they deal with a situation where cars, the average price right now of a new car in the United States is about $50,000. Auto loans, serious delinquencies are at the highest levels going back to 2010. You've seen this being pushed back where suddenly car manufacturers have been trying to lower prices, not raise them. So how do you deal with cars that have low-cost components coming into this country? How do you make it so that you can break even as a car company while still keeping that price point at a place that people can afford it?
Trump, though, said yesterday, after he met with the Stellantis chairman, he told the press that, yes, that's true, I did meet with that individual. He said, I already gave the automakers a big break for this month. I think a key question for tomorrow is if you have plans, say, in Mexico and Canada at the minimum, if you're USMCA compliant, will that continue? These representatives, whether it's Howard Lutnick, Jameson Greer, even Susie Wiles, the president's chief of staff, they are getting a flood of calls from not just automakers, but company after company asking for carve-outs and asking for exemptions.
It all comes down to one man, the President of the United States, at 3 p.m. in the Rose Garden at the White House tomorrow afternoon. Wanted to squeeze this story in. OpenAI, finalizing the largest private tech funding round of all time. According to PitchBook, the company behind ChatGPT secured another $40 billion from SoftBank and other investors for a $300 billion valuation.
Before you take a look at this and say, see, actually the tech bubble is not a bubble and it's going strong, and there's a company that's raising money at twice the pace that it was as recently as October. Its valuation has doubled since then. Pause, take a step back. This is a company that, A, is become completely integrated into a lot of different workflows, but 2, is restructuring itself as a for-profit after having had a non-profit overlay. Now they're going to have a for-profit section, and this could potentially expedite that type of monetization of some of their prevalence pretty much throughout.
Remember a decade ago we used to talk about billion-dollar unicorns?
Yeah.
$1 billion, 300 unicorns. Private market's amazing these days, isn't it?
It's a great point. And actually, this is the reason why increasingly Apollo is saying that there's no daylight between private markets and public markets. And if anything, why would OpenAI, to exactly that point, have to do an IPO, an initial public offering, if they're raising money like this in a private markets with things like Microsoft as well as SoftBank?
That's the latest on OpenAI this morning. Let's turn back to commodities. Gold continuing its record-breaking rally. Bank of America suggesting the precious metal could reach 3,500, driven by central bank buying and haven demand amid rising geopolitical and macro uncertainties. Francisco Blanch of Bank of America joins us now for more. Francisco, welcome to the show. A 19% move in the first quarter, the biggest quarterly gain going back to 1986. Francisco, let's talk about the drivers of the first 3 months of this year before we get into the next 9 months of 2025. What got us to this place?
Thank you for having me again, John. So I think gold has been really drifted up by essentially we started out with central bank buying in the last 3 years, but I think investors have started to accumulate as well. So I think what's really changed has been more investor buying, whether it's through ETFs or other instruments, but also we are seeing asset managers and insurers starting to pile in. So that's been the change. Remember, we've seen a weakening U.S. dollar. We've also seen falling interest rates, at least on 10-year yields in the U.S. And that's kind of led to incremental demand for gold. Plus, of course, there's the issue of tariffs and the potential implications that may have in the economy. So I think all of that has come together. But gold's not alone. I mean, we've seen a big rally across the commodity complex. We've seen also coffee moving up. We've seen, we've seen silver. Actually, commodities are up almost 9% in the first quarter, John. I mean, it's been a really strong run, maybe a little bit of an unexpected run, and the sector has outpaced bonds and equities across the board.
Francisco, before we dive into just generally the commodity rally, how distinct is gold, given its hedge factor, as well as increasing concerns, as we were speaking with George Saravelos earlier, about diversifying away from the U.S. dollar?
Well, so I think there is an element here of diversification, no doubt. I mean, central banks are now holding about 10% of their reserve assets in gold, and that number is likely to continue to increase at an annual pace of 1 to 2%, probably as far as the eye can see. Remember, one of the things that the Trump administration is trying to do is to rebalance the U.S. twin deficits. And that rebalancing of the twin deficits, by definition, implies that there is a lower desire by the Trump administration to continue to supply this reserve asset that the world has been carrying for a long time, which is U.S. Treasuries, right? So if you reduce the deficit, if you reduce the budget deficit, if you reduce the current account deficit and the trade deficits, by definition, there's going to be less treasuries available for central banks around to hold. And then there's the whole sanctions and tariffs overlay here that's also driving the demand for gold.
So I guess that my question for you is, have we seen the bulk of it? Why isn't your target higher? You see 3,500 as your recent target. We were just talking to Ed Yardeni, who left the office saying 4,000 by the end of this year and 5,000 by the end of this year. And it seems like people can't get enough.
Well, I mean, there's a little bit of that right now, but also remember, gold is a pretty large market already, right? It's over $10 trillion in value. So of course you can put any number there because there's no such thing as intrinsic value in something like gold. I mean, there is of course a cost of production, but as we know, mining increases the stock of gold by 1.5% a year. But the real story here is how much investment can you drive in? Of course, gold could spike a little higher, but you would need to see a much worse economic outcome than what the market is currently pricing in our view, right? So it's going to be a steady grind higher as opposed to a big jump unless something dramatic happens.
Francisco, there's a lot of research that all of this has to do a lot with the uncertainty about the trade and the tariffs, that the announcement we're going to get tomorrow. But how much is it just driven by the fact that it is uncertain and most people are projecting the next year to just remain uncertain? So the safest thing is to just go into gold.
Well, again, just mentioned that earlier, it's a combination of factors. When you look at gold historically, it used to be rates, it used to be FX. But now we have this uncertainty, which is, of course, triggering the purchases. But again, the uncertainty is really impacting all investors across the spectrum. As I said, we are seeing retail investors, we are seeing asset managers and insurers, pensions, we're seeing also central banks. So, and again, is it the safest bet here? I don't know, right? But are we going to continue to see interest across the board? Most likely, yes. Now, what are the downside risks? Well, downside risks is that the Trump administration is successful at rebalancing its accounts, and we end up having a very strong U.S. economy with relatively limited deficit, and therefore the U.S. becomes a very attractive place to invest again, right? I mean, a big part of the rotation to gold is also related to the drop in equity markets, the drop in the Max 7, right? So let's say that we started to see again strong growth and strong rebalancing in the U.S. as a result of all these policies. Maybe gold isn't as attractive anymore in that context, right? So I think we also have to consider the downside risks, not just the upside risks. It's never going to be a straight line for any asset.
Francisco, I just want to finish on the availability of gold and maybe lean on your conversations with clients so you can avoid offering your opinion. Unless you've got one, by all means, share it. Do you think they're losing confidence about that gold availability in places like the Bank of England? Is that behind some of the speculative drive we saw into gold over the past few months?
I don't think there's as much like a confidence in terms of the stocks of gold being there. I think it's been more about the movement of gold to Europe into the U.S. ahead of potential tariffs. Remember, there's a lot of instruments in the U.S. that are issued. There are instruments that may have a gold physical backing. And if you've promised investors on any kind of note, whether it's a structured note or an ETF or some kind of fund, that gold is going to be physically available for the investor to take hold in the U.S., you're probably shipping gold out, right? Just in case that those tariffs go up and suddenly you face a big dislocation between the product in the U.S. and the product abroad. And to some extent, we've seen that in other commodity instruments like copper, and a bit less so in the energy space because it's a little more fungible. but investors are rushing to bring stuff into the U.S. ahead of this so-called Liberation Day tomorrow in the Rose Garden. So what is the impact of those tariffs going to be? Well, again, you'd rather have your product in the US of A ahead of that potential price change because unlike currencies and unlike other instruments, commodities are going to suffer the tariffs directly, right? So it's a direct play on the tariffs, and you'd rather be in than out when those tariff walls go up.
Another record high over the past week. Francisco, appreciate your time breaking down gold. Francisco Blanch there of Bank of America. A record-breaking rally through the first quarter, the biggest quarterly gain we've seen going back to 1986. With an update on stories elsewhere this morning, with your Bloomberg Brief, here's Yahara Hackes with more. Hey, Yahara.
Hi, John. Commerce Secretary Howard Lutnick could withhold promised CHIPS Act grants as he pushes companies to expand their projects in the U.S. Sources telling Bloomberg that Lutnick's goal is to generate tens of billions of dollars in additional investment without increasing the size of federal grants. He wants other chip makers to follow TSMC, which recently announced a new $100 billion investment in U.S. plants. Meanwhile, Amazon is bringing back metal detector screening for employees leaving its warehouses. The theft prevention measure was stopped during the pandemic. The company is also asking workers to register their personal phones. Amazon says the changes are aimed at making facilities more safe and secure. And in March Madness, the women's Final Four is set after Texas took down their cross-state rival TCU. They move on to face fellow #1 seed South Carolina for a spot in the national championship. Elsewhere, UConn defeated USC 78-64. The win marks UConn's 16th Final Four in 17 years. They're set to face #1 overall seed UCLA. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later in the program. You've gone quiet.
Well, I'm not doing well anymore. I had USC beating UConn, so
gotcha.
That kind of stinks.
Lisa's not even playing. Neither am I.
Sorry.
Just to be clear.
It's like roulette.
Up next on the program, turning the page on Q1.
The market now is laser focused on this tariff or trade issue. Expectations are probably not where reality is, which is that growth is worse than people thought, and inflation's a bit stickier. I'm not willing to throw in the towel yet completely on the full year.
Up next on the program, John Bilton of JP Morgan Asset Management, live from New York. You're watching Bloomberg TV.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Snapped a 3-day decline in yesterday's session to close out Q1, but Q1 was brutal, and so was March for the Nasdaq and the S&P. The S&P is down by 0.5% this morning, just a little bit softer as we kick off Q2. Under surveillance this morning, turning the page on Q1.
The market now is laser focused on this tariff or trade issue. Expectations are probably not where reality is, which is that growth is worse than people thought. And inflation's a bit stickier. I'm not willing to throw in the towel yet completely on the full year because, as we've been saying, the good stuff of the policy changes that we expect could start to feed into the equity markets by year end.
So here's the latest this morning. The first quarter wrapping up with sinking sentiment and slashed growth outlooks. John Bilton of JP Morgan Asset Management writing, trade wars, a pickup in inflation, or overly restrictive monetary policy prevent risk to our view. Nevertheless, we're optimistic that as policy trajectory becomes clearer, we will find opportunities to add risk. John joins us now for more. John, welcome to New York.
Thank you.
At the end of December, if I'd promised you 20% off tech firms on the planet listed here in the United States, would have snapped my hand off. Are these companies still the same?
Well, broadly speaking, I mean, the trend towards technology democratization, everything we've seen in the first quarter, the projects being initiated on AI, they're still there. This is a super trend. So, ultimately, you're right. And I think it's worth looking at the valuations. It's the biggest tech firms in the US are now 4 turns of valuation below their pre-COVID levels. So as a result, you are looking at a market which has cheapened up significantly. Tech probably is the top side risk to the S&P these days.
So if that's the case, why aren't you buying aggressively?
Well, because I think we've got to sort of take the index as a whole, and we've got to look at opportunities here and there. At the moment, if we look at the cyclical sectors and the rest of the S&P 500, actually stocks outside those top 6 are about a turn expensive to where they were pre-COVID. So if we put it all back together, then you get some ability to be able to pick out sectors and stocks. This is much more of a sort of stock picking market, I think, than necessarily taking a big macro bet on the market, particularly when we've got this kind of policy uncertainty around us.
Hold on a second. You just said that some of the cyclical stocks are getting expensive. People have been talking about a broadening out, a rotation into the wider S&P 500. Are you saying that's over?
Well, no, I'm not saying it's over. I'm saying we need a little bit more certainty about where the direction of policy is going. Right now, investors are sitting on their hands. We've seen some earnings downgrades coming through. So ultimately, I think what we need to understand is where the overall macro landscape is evolving to. At the end of the day, the US economy is still reasonably robust in our view, but it's cooling to some degree. And as a result, that's making it harder to make those earnings upgrades come through. But what's been hit really hard, of course, are those sectors that had driven the market last year and the year before, and those have gone through the hardest of the de-rating. So now we're actually looking at them, and they're beginning to become attractive both in terms of their valuation, but also the quality of their earnings and their cash flows.
How nervous should European longs be going into tomorrow?
Well, therein lies the question, doesn't it? We've had Germany, obviously, pre-announcing a massive fiscal package, huge fiscal package. Could add 60, 70, 80 basis points to growth, on average over a decade. Thing is, it's going to take a while to ramp up. And of course, we've got tariff potential going the other way, which could take that straight back off the slate. So, if anything, when we look at where we are in Europe, we think we're perhaps a little bit over our skis. We're not going to chase this market. It's gotten expensive. So, we're about a turn and a half expensive in the European indices compared with the 5-year median valuation. And earnings, if anything, seem to be a little bit enthusiastic for where the economy is going just now.
So are we back to the narrative that U.S. exceptionalism is back?
I don't think U.S. exceptionalism ever went away. Let's be crystal clear here. The U.S. corporate sector is the envy of the world. It's not just the idea of the economic policy. It may be true that the U.S. is cooling some, rest of the world is doing a little bit more self-help. It may narrow the U.S. rest of world growth gap. But the corporate sector, the whole ecosystem, the public-private market interaction, the innovation, the degree of governance within US corporates and the quality of cash flows still remains exceptional in our view. It's simply the case that it may have been overpriced relative to opportunities in the rest of the world. So there's still great opportunities to pick alpha, pick good stocks, pick good sectors, and I don't think that's gone away.
Is there a sector, though, that comes to mind that's not going to be hit potentially tomorrow, or the retaliation of what we might get tomorrow?
Well, I think we're getting to a point, and we've got to look also at sectors which perhaps have really priced in an awful lot of bad news. If you look at some of the CapEx surveys within the US, we're now down at levels which we were at around about the COVID pandemic. Corporate confidence, it's very, very low. Corporates are not over their skis. CapEx plans have been put on ice. So effectively, you've got firms sitting on their hands. As mentioned earlier, we still think that tech has really derated a good long way. These are still good quality companies generating huge amounts of cash. I think the financial sector looks reasonably good. We quite like utilities as well. So there are a number of areas where we see opportunities. And I think that's really going to be the signature of this year. Rotation's not dead. It's just not necessarily going for growth at all costs. It's looking for resiliency, quality of cash flows, etc. And that's, I think, what is going to come to the fore.
I feel like people are also falling in love with bonds again. And I'm not talking about treasuries, but credit in particular. I hear that a lot, that you want income and you can get it. You can get 7.7% on high-yield bonds at a time where that's a steady cash flow. Sentiment's cratering, but cash flows aren't. Is that kind of where you are, too?
In many regards, we've been in credit now for quite some time, seeing it as a really good diversifier to equity. Different set of sectors, different set of exposures. You're playing the balance sheet, not the income statement when you're thinking about credit. And the US right now, we're talking about growth. We're not really talking about the balance sheet. The US looks pretty solid. If we look at the consumer balance sheet, the financial sector, corporate sector, it's all fairly strong. And as a result, we think that the credit is quite resilient. We're not seeing the US in a position where it collapses into recession. We're seeing the US as an economy which is cooling down to a period where we've got a bit of sub-trend growth. Corporates sitting on their hands, consumers sitting on their hands. As a result, credit looks pretty good. A good way to just be clipping the coupon a little bit higher up the capital stack.
John, 20 seconds. What's the biggest difference right now between conversations you have in Europe and conversations you have in New York in the past 2 weeks?
Folks have just suddenly rediscovered the region they live in. All of a sudden, it's not dead money anymore. And people are asking questions. Yes, it's expensive now. Cash flows maybe not as strong as they could be, but folks have realised it's still there on the map.
It's a major change. John, it's good to see you. It's great to catch up.
Thank
you. John Bilton there, JP Morgan Asset Management, are some of the changes we've seen in Q1 and what you can look for in Q2. In the third hour of Bloomberg Surveillance, up next, we'll catch up with Emily Rowland of John Hancock, John Lovallo of UBS, Tiffany Wilding of PIMCO, and Tom Tsouras of Strategas. The big days tomorrow, big tariffs coming from the President of the United States. Equity futures on the S&P near session lows. We're negative 0.5%.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis. So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
If we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
There probably is still, to some degree, a level of a correction coming. There may very well be more to come.
The market's trying to find a bottom. Things will recover.
Markets are down. It's not just a rotation underneath the surface.
I've sensed this bearish sentiment on the rise, especially in the last few weeks.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bell 90 minutes away. The third hour of Bloomberg Surveillance starts right now with equity futures declining by 0.5% on the S&P. The Nasdaq 100 looks like this. We're down across the board here by 0.5% on the Nasdaq, by 1/3 on a Russell. Elsewhere, your day ahead looks like this. Later on this morning, ISM manufacturing and JOLTS job openings. Look out for that alongside the ISM. Of course, we'll hear from the President of the United States later on this afternoon. Then when we get into the rest of the trading week, you'll get more data. ISM services, jobless claims, and payrolls. This morning, though, we start with this report coming from the Washington Post and this headline right here. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States, according to 3 people familiar with the matter. The situation, as we've said repeatedly, is fluid. One man gets to decide, the President of the United States.
20% tariff rate would be the maximalist approach. We've heard from a number of different investors and analysts. Key question about if this is a starting point, where the negotiations are going to be, how long this is going to draw out, and frankly, whether there is going to be some sort of damage in the meantime. You have, for example, Goldman Sachs now seeing a 1 in 3 chance of recession with a 15% tariff rate. This would be materially more, something that a number of firms have come out and said would ensure recession.
Right now, what you have is peak competing interests within the White House. I look at this report, 20% across the board for revenue raisers to offset, potentially give a tax rebate to the American people. This sounds like one camp, a very maximalist camp when it comes to trade, the likes of Peter Navarro. Last night, we heard from the Treasury Secretary, and he was asked about this. Of course, he didn't want to get ahead of the president, but Scott Bessent said everyone will then have the opportunity to lower their tariffs. lower non-tariff barriers, stop FX manipulation, basically saying this is the beginning of a negotiation, not the end.
Is that how the Europeans see things? Ursula von der Leyen, the European Commission President, saying we do not necessarily want to retaliate. If necessary, we have a strong plan to retaliate, and we will use it. Let's see how quickly they plan to deploy it.
We've seen this pretty much repeatedly. Even Canada, you have, just coming out and saying, Mark Carney, our relationship, which has been in place for 100 years, is now changed. And you've heard that pretty much across the board. Are these just hard words? Have they tried to negotiate with the president? How do they get leverage heading into negotiations that could drag on for a long time? But more important, the uncertainty is not going away. And that is the reason why people are factoring uncertainty into their forecasts and into their valuation models.
Another price target cut on the S&P 500 overnight, this time from Ed Yardeni. Ed Yardeni does it twice. He says the expected fallout from Trump's 2.0 reign of tariffs undercuts our former bullishness and dims the prospects of our base case roaring 2020s scenario.
He still sees roaring 2020s as in effect, but dampened significantly based on some of what we have seen with respect to the tariffs. The speed of which people have downgraded. We talked about this with respect to Goldman Sachs, David Kostin, twice in 1 month, just with a couple weeks in between with downside expectations. This is something that people are grappling with at a time when uncertainty has a cost and conviction has a cost. And I will just say the data that we get today, ISM, is going to be very interesting because manufacturing is supposed to go lower, and then prices paid expected to go higher, and that's not what people want to be seeing.
We can still end up in a good place. A lot of equity market bulls have said the same thing. When we spoke to Ed Yardeni still sees stocks higher at the end of the year, but the conversation has to move away. We were talking to him about this. I've never seen sentiment this week collapse this fast outside of a recession. The hard data has barely moved just yet. We get more hard data later on in the week. But you can see the conversation being pushed along down in Washington towards taxes. Secretary Besson only in the last 24 hours talking about no tax on tips, on Social Security, on overtime. We're going to make purchasing an American car tax deductible all over again. That's the effort down in Washington.
The sweeteners to offset this. The problem with that is you've got to get it through Congress, and then there's a bill associated with it. And even the bill that they have right now, the tax bill, has a $4 trillion expansion of the deficit over the next 10 years. There is an upside, though, which is the reason why it's a tale of two halves that a lot of people have been talking about.
Sequencing was always going to matter. What would they start with? And they started with, in the minds of this market at least, in the opinion of investors, they started with the negative stuff, and the positive stuff could come later this year. Equity futures on the S&P 500 negative by 0.5%. Coming up this hour, we'll catch up with Emily Rowland of John Hancock with 1 day until the big tariff announcement. John Lovallo of UBS on the headwinds facing home builders, and Tiffany Wilding of PIMCO on threats to U.S. exceptionalism. We begin this hour with stock steady as traders await President Trump's reciprocal tariffs. Emily Rowland of John Hancock writing, there is still a broad-based global economic cycle that will drive earnings and valuations on stocks overall. This cycle may be borrowed time as recent economic does start to show cracks. We would consider further pruning risk in portfolios. Emily joins us now for more. Emily, welcome to the program. We're seeing some major moves in this stock market through the first quarter. Do you see some big opportunities opening up now?
Yeah, John, so we are actually going to be moving to neutral on U.S. large cap equities and actually allocating those assets to credit. And really, it's not necessarily about the policy uncertainty. It's really just about the starting point. U.S. stocks have handily outperformed credit really since the stimulus boom in response to COVID. And we've seen a couple of exceptional years where earnings have been phenomenal. We've seen massive multiple expansion, back-to-back 25+% returns for the S&P 500. So we're looking to where we can prune a little bit of risk off the top there. And global equities are really what's benefiting from this rotation. It is amazing to see what the leadership has been. It's German industrial companies, it's European banks, it's Chinese technology companies. That's a really odd mix in our mind, especially as we think about the potential for tariffs to create this negative growth environment. We would actually be looking to look at income as a more important component of a portfolio than capital appreciation. So we're actually looking, again, to go neutral on credit and neutral on U.S. large caps.
You mentioned the outperformance we've seen abroad, the outperformance we've seen in places like Europe. Emily, do you think some pain might be in store for some of those European longs going into tomorrow's announcement?
I think they could be challenged just because of the velocity of the move that we've seen there. Again, if you guys remember that Sesame Street show where it was like one of these things is not like the other, that's what we keep thinking about as it relates to the cross-asset performance profile in the wake of this policy uncertainty. U.S. small cap stocks theoretically should be benefiting from the potential for these America First policies. We should see the U.S. dollar strengthening theoretically. That's not happening. Instead, we're seeing this massive sentiment-driven rotation into these cyclical areas of the globe. Typically, cyclical assets should do best coming out of a global economic downturn, and we're actually seeing them outperforming in a late cycle environment. So I think that sentiment could shift rapidly here. We have to remember that this is a global economy. If U.S. exceptionalism is at risk, if U.S. equity exceptionalism is at risk, broad equity exceptionalism here is likely at risk as well, which is another reason we think that income is going to be a more important return driver than capital appreciation.
Emily, that is the line that I want to pick up on. If U.S. equities have lost their exceptionalism, the rest of the world's equities have also lost their exceptionalism, which is a reason why you see a good place for income-producing assets. I wonder, do you see bonds as actually outperforming equities this year amid this focus on income and not necessarily equity premium?
Yeah, we do actually, Lisa. And some of the reasons that we've, made this decision is kind of just thinking about that potential. You mentioned before, U.S. high-yield bonds are yielding almost 8%. Yes, there may be some spread widening, so we've come off the lows of about 250 basis points over treasuries to a little bit over 300 now. Maybe could see a bit more spread widening here, but now the income is enough in our view to overcome that. You look at standard deviation over the last 10 years for the S&P 500, about 18. We're looking at about 5% standard deviation on high yield bonds. And then finally, looking back over the last decade, the maximum drawdown that we've seen in stocks is about 33%, and it's 21% in high yield. So it's not that we love credit within the context of fixed income. We actually still have an overweight to higher quality bonds over credit, but within the entire portfolio, we think being able to maximize or to minimize drawdown, to be able to lower standard deviation, and to be able to get nearly an 8% income on high yield is a decision that makes a lot of sense.
Emily, when we started the hour, John talked about how sentiment's never been lower, at least not in the recent past, even though we haven't seen an even bigger bear market in the broader stocks. And then I started to list off this recession call, this recession call, this person is downgraded 5 times. And I was thinking to myself, I sound really bearish and I sound as though we're heading into Armageddon. And is that a contrarian indicator? The idea that we have discussed all of these worst case scenarios at a time where the consumer's balance sheet is still pretty good. You do have companies that are still performing okay. Is there a sense that maybe we've gone too far and equities can reverberate back, especially led by big tech?
There is. I mean, at the end of the day, it's not that bad as it relates to the hard data. We watch things like initial claims really closely on Thursday mornings. We've been in the low 200,000s. There are some cracks forming there. Continuing claims are elevated. We've seen job openings slowing. We'll get another read on that this week, but the hard data are holding in really well, especially as it relates to the labor market. The challenge is the soft data is horrible. Consumer expectations hitting a 12-month low. University of Michigan sentiment index declining. You all have talked a lot about that on the show. We've got to be mindful of that. First of all, that soft data just soared after the election. We saw just massive optimism, things like home builder sentiment, NAHB. Again, some of the sentiment surveys around expectations soaring, especially on the Republican side. But we've seen a little bit of a give back there. And then we also have to remember that businesses and consumers sometimes say one thing and do another. I think durable goods coming in solid last week was another example of that. So we've got to be mindful. I'm not saying completely ignore the soft data, but we're watching the hard data for signs that a contraction is happening or something more nefarious is going on, and we're just not seeing it.
Emily, appreciate the update as always. It's good to see you. Emily Rowland of John Hancock. Sentiment has almost collapsed over the past few months. This hard data really has not. Maybe it will follow the survey data. Payrolls is going to be a monster data point for us on Friday morning at 8:30 Eastern Time. A sneak peek of our survey, 140 is the median estimate for Friday for headline payrolls. Then, Lisa, later on in the afternoon, you'll hear from Chairman Powell for his view going into the weekend.
And this has become a trend. He likes to come out and discuss something, message something, even though he then says, I have nothing more to say because, frankly, I'm in a black box with a blindfold, just like everybody else. I will say one hard data point that is showing some signs of what we're seeing in the soft data has been the ISM services and manufacturing data. We do get manufacturing today, and maybe more than any other indicator right now, you are starting to see that stagflationary feeling come into the hard data. That is what I'm watching. The jobs picture is going to be muddy and backward looking, and people will dismiss it. But you're going to see some of these other soft metrics or hard metrics start to shift just a little bit.
More survey data a little bit later. Equity futures right now in the S&P negative by 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. President Trump said his first trip this term will likely include visits to Saudi Arabia, the United Arab Emirates, and Qatar. Trump added that it could happen next month, and he'll likely make additional stops. His remarks come after Axios reported that White House officials were planning Trump's first trip to Saudi Arabia in mid-May. Meanwhile, President Donald Trump signed an executive order aiming to crack down on ticket scalping and fees that drive up the cost of attending live events. The order is similar to former President Joe Biden's move that targeted junk fees and pushed transparency in ticket pricing. And Goldman Sachs has drawn more criticism for the $80 million bonuses it plans to give the bank's top two leaders, David Solomon and John Waldron. Institutional Shareholder Services, a proxy advisor, is urging investors to reject the rewards at an annual meeting. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara later on this hour. Up next on the program, the Morning Calls Plus, John Lovallo of UBS as home builders brace for reciprocal tariffs. Those tariffs drop tomorrow. Live from New York, this is Bloomberg.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The opening about 1 hour and about 14 minutes away. Equity futures down by 1/3 of 1%, bouncing just a touch going into the cash open. We're lower here by, let's call it 1/4 of 1% on the Nasdaq 100. Let's get you some morning calls. First up, Jefferies downgrading Southwest Airlines to underperform, citing uncertainty around consumer and corporate spending. That stock is down by 2.4%. Your second call from Melius downgrading Kroger to sell, pointing to competition from Walmart and a C-suite transition. That name is down by 0.9%. And your third and final call, Morgan Stanley upgrading Dr. Pepper to overweight, highlighting the company's growth potential. That stock is just about unchanged in the pre-market. Let's turn to the home builders. John Lovello of UBS seeing a challenging backdrop ahead, writing the housing industry faces numerous headwinds this spring selling season, including choppy demand, volatile mortgage rates, potential cost pressures from tariffs and immigration reform, and Doge layoffs. And John, the list seems to go on and on and on. It's good to see you.
Good to see you.
How does this get any easier anytime soon?
So, look, I don't think the picture is all that dire. There are a lot of challenges out there, tariffs being kind of front and center. But if we think about the numbers behind tariffs, maybe to start, about 7% of goods and I'd say materials and sort of equipment that's used in residential construction is imported. So it's a relatively small number. The National Association of Home Builders has said that about $9,200 in cost per home. If you think about a home, the average price is $415,000. So that would be about an 8% increase in material prices, probably closer to 9%. It can be offset by about a 2% increase in price. We think that the pain gets shared across the value chain. So it's going to be the manufacturers, the distributors, and the home builders. So it's not all going to be shouldered by the home builders. So I think the way we've been kind of framing it is that tariffs are not good. Lumber is the biggest impact. 25% comes in from Canada. But it's likely manageable across the value chain.
So you think we have the lumber capacity in this country to go forward with residential housing without getting Canadian lumber?
It's a great question, right? If you think about the U.S. Lumber Coalition estimates that we could handle about 95% of capacity that's coming in, domestically. The capacity, the utilization rate in the U.S. right now is around 65% for the mills. So the 25% that's coming in from Canada could likely be resourced. Now, that doesn't mean that there's not going to be some cost pressure.
Okay, so there's cost pressure when it comes to tariffs, although it could be offset in terms of who bears the brunt of it.
Right.
At the same time, most economists seem to think that a lot of the tariffs on the table here will slow growth in the United States. And that might be the biggest headwind to the housing market, with housing stocks down 7% so far this year. How do you factor that in at the same time that you've got these cost pressures?
Yeah, no, it's a great question, Lisa. Look, I think that is the biggest risk, is that the economy slows, the consumer fades even more. And look, I mean, buying a home is the single biggest ticket item you're going to purchase in your lifetime. And so I think to the extent that the sentiment really sours, it's going to be pressure. There's no question about it. Now, that being said, there's still a structural kind of shortage of homes out there. There's underlying demand with demographics and all that kind of stuff that could be an offset.
What's sort of a strange conundrum for me is when I look at the housing stock that's been created post-pandemic, it's in very specific areas. It's in the Sun Belt. And now you're starting to hear about inventory overcapacity in a couple of areas where suddenly prices are actually going down. You're not seeing the same kind of demand at the same time that there might be a lack of inventory in other areas that didn't get built up during the pandemic. How does that complicate the picture?
Yeah, it's a tricky situation where I think that the four big markets where there's been inventory build are sort of in the I-4 corridor in Florida, so between Orlando and Tampa. That our channel checks would suggest has actually started to get worked down. And so it's in a little bit of a better situation than it was. Phoenix was another kind of MSA that was challenged. That's improved pretty dramatically. Austin remains a bit soft. There's still a lot of inventory, some price realization that's going on there. I'm not saying it's a perfect situation, but it does seem like it's getting incrementally better. Now, if demand were to slow further, you could see that inventory build up again. And we still have some work to do.
If we go back to the tariffs, because they're weighing on the market for tomorrow, we talked about Canada. What about Mexico? Because a lot of home builders have diversified away from China, but they're still very reliant south of the border.
Yeah. So I think, to frame it, I would say from Canada, lumber is the big deal. 25% comes in from Canada. In terms of Mexico, the big sort of import would be gypsum mineral that's used in wallboard. So that is something certainly to consider. A lot of our companies have exposure in Mexico in one way or another, so it will be an impact. China, from a home building standpoint, is largely appliances and some materials that are used in plumbing fixtures. Things.
Can they make up those supplies in Mexico in the United States?
It's going to be challenging. I think that there are ways to offset some of those cost pressures for sure. And again, I think that the customers being so big, the home builders, that there will be some pushback that they'll be able to kind of put into play. But look, I mean, these cost pressures are real. I'm not trying to sort of poo-poo the tariff situation.
One feature of our conversation so far this morning is just how much consumer sentiment has been hit.
Yeah.
And how much consumer sentiment has been hit outside of a recession. Have you ever seen it like this before?
I can tell you that this is the worst that I've seen sentiment from an investor standpoint relative to our group. It's pretty bad, and I would say from a consumer, standpoint, it doesn't feel great either. Now the consumer still feels like it's in reasonably good stead, but that could change. And it's at the biggest risk, as Lisa was talking about, is that if the consumer sours further, all bets are off.
Is sentiment a leading indicator or a lagging indicator at this point?
It's a good question. I think it's. Here's the cop-out answer. It's a bit of both, right? I mean, I think that there are certainly lagging aspects of it, particularly as it pertains to inflation. But I think that there's always somewhat of a forward-looking element as well with people.
So I'll lay out the concern that I have right now as a homeowner. Yeah. I'm sorry, it's going to get a little personal. But I'm looking around and I'm thinking the home builders did really well during a period of time where there was absolutely no inventory whatsoever because no one was selling because mortgage rates were too high. What happens if mortgage rates, long-end rates, fall significantly because of some sort of downturn and suddenly there's inventory and lower rates, but at the same time, people can get homes that previously were in existence? Mm-hmm. How much does this undo the odd pop that we saw in home builders immediately post-pandemic that was completely unexpected given how much rates went up?
It's interesting. Look, I would take lower rates all day long, even if it brings inventory into the market. It just broadens the pool of buyers that can actually enter the picture. Now, keep in mind, too, that the inventory that's out there, the housing stock in the U.S. is old. It's over 40 years old. It's generally at price points that are not most attractive to the first-time buyer that's very active in the market today. And so I think you have to look at actual inventory and sort of desirable inventory. And there's a big difference between the two. But even if all that inventory did come back, lower rates is just better for housing. I mean, the existing home market is at a standstill. We're just over 4 million units. That should be 5 million or 5.5 million units. So it's a dysfunctional market. We need that to improve, and that would help all of housing.
In sum, you're bullish?
We are still bullish. We are, yeah. And I mean, believe it or not, look, I think that the stock's trading at 7 times earnings and close to book value. A lot of this bad news is factored in our opinion. And generally speaking, when it's the scariest out there, it's the most attractive time to get involved.
Lisa's looking for recessionary interest rates to make the housing market great again. That's about as bullish as Lisa.
No, I'm actually wondering, will it make the housing market great again if people don't have the confidence? I don't know. I'm not talking my book. I'm just speaking my anxiety.
You're looking to move?
No, she's
locked in on 3%.
Okay, look, we don't need to get into my situation.
True. Maybe if you want to upgrade
okay, all right. All right, let's move on. Really, I'm just saying.
A little bit.
It's just really strange that we saw interest rates really high, but valuations didn't go down.
It's been a bizarre dynamic over the past few years, that's for sure. John, it's good to see you. Thank you, sir. John Navarro there of UBS. Up next on the programme, we'll catch up with Tiffany Wilding of PIMCO. Talk to her about interest rates and the economic data still to come this week. It's not just about tariffs. We've got payrolls on Friday, and you will hear from Chairman Powell going into the weekend. We'll also speak to Tom Sitsouras of Strategas, a bad company, and what's happening with fixed income. What's happening this morning? Bond yields are lower by 5 basis points on 10s to 4.15. In the equity market, we're lower too by 0.5%. From New York City, this is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
60 minutes away from the opening bell with equity futures down across the board on the S&P 500 negative by 0.5%, on the Nasdaq 100 down by 0.4. In the bond market a bit again, yields lower across the board on a 2-year, 10-year, 30-year. We're down 5 basis points at the long end on 10s to 415, on 30s to 452. Later on this morning, 10 a.m., JOLTS job openings and ISM manufacturing. Just how much weakness will we see in the data going through the week?
And not just weakness, but at the same time, an inflationary impulse still there, kind of reiterating what we've seen in some of the sentiment surveys with ISM manufacturing. The index level expected to come down, prices paid expected to go up.
Let's finish on foreign exchange. Euro dollar pulling back south of 108, 107.91, negative by 0.2%. PIMCO releasing its latest cyclical outlook, writing the following: at a time of sweeping geopolitical change and clear challenges for riskier assets, bond markets offer a source of stability. Tiffany Wilding of PIMCO joins us now for more. Tiffany, a port in the storm. Let's talk about the storm and the epicenter of that storm, as you and the team have indicated, is the United States and U.S. policy. How dark are those clouds going to be tomorrow afternoon at 3 p.m.?
Well, I think just taking a step back, I think it's been incredibly clear what the Trump administration is trying to do. I think what's less clear is just that amid the constraints, political, legal, economic constraints, how much disruption are they willing to tolerate? So we would argue that the three things that they're most focused on are reducing the trade deficit, reducing the federal government fiscal deficit, and of course, returning the middle class in the United States from its current hollowed out place. Now, those are structural issues that require structural changes, and the lever that the administration is pulling is increasing tariffs. So, they've been much more aggressive at every step of the way than I think most people expected, anyone expected. And we think tomorrow, similarly, we'll get an announcement that, has a similarly aggressive increase in average effective tariff rates in the United States to levels that we have not seen since the 1930 Smoot-Hawley Act.
Tiffany, do those levels stick, or is this the beginning of a negotiation?
Well, I mean, you have to believe this is the beginning of a negotiation. Obviously, there's a lot of uncertainty around that, and how ultimately that plays out. But I think we really just don't have a good sense because we haven't seen this type of shock, in quite some time. Obviously, global markets are much different now than they were in the 1930s. It's difficult. There's the potential for what economists call, quote, non-linearities. Supply chains are much more integrated these days. And we saw that during the pandemic as well. And so I just think there's a lot of uncertainty around the economic effects if these things stick. And as a result of that uncertainty, by the way, we've argued that the bond market is a place where investors, can look to seek some stability in terms of their outlook for returns.
How do you start to think about what potentially this could look like when you start to look at each country and their retaliatory measures they may take on the United States?
Yeah, I mean, so this is certainly a multifaceted game, and that's going to play out over the course of this year. Now I think it's not only the other countries' willingness to tolerate some economic pain. Global uncertainty and trade uncertainty will impact every economy, but it's certainly on the U.S. side as well. Our economy, the U.S. economy, is as you mentioned, it's kind of ground zero for all of this. We've already seen a deterioration in both consumer and business sentiment. I would argue that one of the reasons why the administration won was because people were, the price level adjustment that we've seen over the last several years. People are wanting a reversal of that. Obviously, we'll get more of that price level adjustment, some more temporary inflationary pressures as these tariffs are passed on. So I think there's some real political questions around how much or how long the U.S. administration can tolerate this. And so I think that all of that, again, just creates a lot of uncertainty on ultimately how this will play out.
Tiffany, I want to pick up on something that you said, that you see fixed income as sort of a port in the storm, or something that could perform better than equities over the near term and potentially even the medium term. You wrote, markets are in the early stages of a multi-year period in which fixed income can outperform equities while offering a more favorable risk-adjusted profile. Can you explain your thinking at a time when some people are worried about stagflation, the idea that inflation could really pressure some of these yields and actually make a complicated picture for bond investors too?
Yeah, well, ultimately, starting yields within the bond market, high quality bonds are a very good indicator of where the 5-year returns can be. And just starting yields are actually quite attractive now, relative to, call it the last 10, 20 years. And so you can construct portfolios, with yield levels that are, kind of historically in the range of where average equity-like returns are. Then against that, you look at various measures of U.S. equity valuations. You kind of pick your favorite one. Equity risk premiums is something that we like to look at. It's relative to bonds. And you just don't have. It's very tight. Looks very expensive. So we think even relative to its own history, relative to other asset classes, you can look to the bond market here. And I think the other thing is just within bond markets, diversifying and looking for opportunities outside of the United States. High quality areas within EM, for example, where you have a macro backdrop that is, also favorable for the bond market. That can provide a lot more stability and return potential. And if we do get a downturn in the United States, we've heard a lot about recession risks rising. You expect your bond portfolio to provide a pretty good hedge. So the bond market right now is sort of paying you for stability.
So in other words, you're saying that you don't see equities performing better than 4 to 8% on an annual basis for the foreseeable future?
Well, when you have starting valuations at these levels within equity markets, historically you have lower return potential, and again, and there's a wide distribution around those outcomes, right? It's less certain, whereas starting yield levels within the bond market, you're pretty certain that you're going to get that over a 5-year period.
Tiffany, always great to hear from you. Tiffany Wilding there of PIMCO, up early for us on the West Coast. Let's continue the conversation now. Tom Tsouras of Strategas, a Baird company, joins us now for more. Tom, good morning.
Yeah, good
a once-in-a-generation type of discussion in the United States. That's what you're calling this. Yeah. Why is it that big, that important?
Because, in my opinion, and this is not, as far as I know, the stated goal of the administration, but if these tariffs come in as expected tomorrow, and potentially there are retaliatory tariffs and there is a global trade war, then we're talking about really a shift away from consumption and towards savings, particularly centered in the U.S. And the U.S. consumer has been the global consumer of last resort. So this is a complete paradigm shift if those tariffs come in as expected and as televised.
It's a massive rebalancing. What does it mean for treasuries?
Well, a lot. But by the way, I would absolutely agree with Tiffany's comments that despite a lot of volatility in the economy, treasuries and high-quality corporates as well should be kind of a safe port in an otherwise stormy environment. But what we think is it's going to lead to still some yield volatility, but you're being compensated for that. So I think it means that for now you're talking about a flatter curve as the Fed kind of holds tight and doesn't want to cut just yet, but eventually curve steepening.
What if that storm rains stagflation?
Well, then you're probably talking about a flatter curve for longer, but at higher levels. And that's
So the whole curve shifts up.
Exactly. And which, by the way, to Tiffany's point, that's one of the reasons why you can do things with your bond portfolio to adjust for that and to accommodate that now that yields are already higher.
Are we pricing in the slowdown, not pricing in maybe some of the growth aspects, the things of the second half that will spur some sort of growth while also continuing inflation?
I'd say yes. Unfortunately, part of the problem is we don't know what those things are that could spur inflation in the second half, retaliation on tariffs. We also don't know what tax cuts are going to look like for 2026, which could be a big impulse for the consumer again and for businesses. So a lot of those are really uncertain until we get through this tariff discussion.
As Tiffany was talking, I was thinking about the idea that suddenly going into bonds at the same time that you have countries around the world engaging in a fiscal outcome, right, trying to borrow more to stimulate their economies. It raises the question, when does that type of paradigm shift as well? The idea that you can buy bonds as a haven, if that is some of the source of volatility and the source of leverage for a lot of different economies.
Well, and for terms of portfolio construction, what this probably means is as a standalone portfolio for income generation and capital preservation, bonds work. As a beta balancer against the volatility in your equities, they may not work as well. We've seen that the last few days as equities have been off again, and you've seen bonds rally, but not a huge kick from bonds. So you're not getting that beta offset from bonds. That's really what it means.
We've been flirting with this idea for a number of months now. If you have the source of volatility in the government bond market, that is the real question here, the fiscal sustainability of the United States, this question of policy uncertainty. Could we be entering a period where high-grade corporate bonds end up trading inside government debt?
That's a tough call. Folks have been arguing for that for 100 years, and it still hasn't happened yet. There's a lot that has to happen, especially when you're the global reserve currency for corporates to trade tight to treasuries. Honestly, I don't see it happening in any sizable way.
When it comes to the tariffs tomorrow, what do you think is the end goal? Is it revenue raising or is it deal making?
Both.
How? How can it be both?
Well, because revenue raising, because we've got this expectation of tax cuts next year, which is really a big part of the Trump administration's promises, campaign promises, making the tax code fairer for the average American. So that is a primary goal. But obviously, in the short term, there is a goal on getting fairer trade deals and getting our allies to move in line with the strategy, a global geopolitical security strategy. So I think for now, the primary goal is just to see what the reaction is from our trading partners and to get essentially concessions from them. Longer term, it is to see how much we can actually extract in terms of revenue, so that will help to provide a baseline for what the tax cuts will be next year.
So the first case is deal making, and then whatever deal you don't strike, then you revenue raise. Is it going to be enough revenue raising, though, to get the kind of tax cuts they're talking about? I'm not talking about extension of TCJA. I'm talking about all the extras the administration has been adding on.
Very likely no, but that doesn't mean they're not going to try.
So you think they go through with it, and they were able to get some of those sweeteners?
I think so, yes. I think this will provide a substantial offset to the tax cuts, but I don't think it's going to completely offset those tax cuts in terms of revenue lost.
Hey, Tom, good to hear from you. Tom Tsouras there of Strategas, a Baird company. The latest on the consumer, this from Neil Dutta of Renmac just moments ago. Consumer spending doesn't have anything really going for it right now, and if the U.S. consumer does not have a lot going for it right now, the U.S. economy doesn't either. Goes on to say the weak growth in consumer spending nearly ensures a below potential growth environment.
He points to the fact that retail gas prices have been climbing. He talks about job openings, which you're going to get at 10 a.m., at least from the JOLT survey. Continuing to slide, he points to Indeed.com and how job postings have been falling to a year-to-date low. These are some of the indicators people are looking at to get a sense. My question to Neil, and I'm sure, and I missed him yesterday, I'm sorry.
Neil's watching, so
Neil, I guess that my question to him is, does he think that the Fed should respond to this? Because at a certain point, if it's a stagflationary concern, what Neil's been arguing for is for the Fed to cut. But how do you get ahead of something where the pressures are incredibly different than they have been in the recent past?
Richard Carter, the former Fed vice chair, was on the program with us a little bit earlier this morning. He basically said they'll be late because they don't want to be too early. That speaks to what you're talking about right now. They're not going to step in, conditioned by what happened in 21, 22, his view. because they're conditioned by that, they're going to wait to make sure they get this right.
Especially given the fact that expectations among consumers has been climbing for longer-term inflation. They don't count University of Michigan, okay, but there are other surveys that indicate, in particular from CFOs and CEOs, they expect to raise their prices with slowing growth. It creates a real challenge for a Federal Reserve that has ostensibly a dual mandate.
Neil has been arguing that they should be cutting because when the Trump administration came in, the economy was already weaker, and that what you hear now from a lot of people is that they're just using tariffs as this latest excuse of basically what he says was already there and underlying issues with the economy.
Jobs data drops then later on this morning at 10 a.m. I'll tell you the data point I'm looking for. It is a bit dated. It's February data. It always is a bit dated when we get jobs, but I'll be looking at the quits rate because the anxiety around unemployment is captured in the surveys that we've seen from you, Mitch, from others as well. And if you're feeling anxious about higher unemployment in the future, are you quitting your job? The answer to that would probably be no. So let's see if that drops as well in the next couple of hours.
And if that does drop, it'll just add to this feeling the labor market isn't quite as tight as people previously thought. On one hand, inflationary pressures, that diminishes on that side. On the other hand, if you're looking for a slowdown, that adds to your case.
The big data point drops this Friday. Payrolls at 8:30 Eastern Time. In our survey, 140 is the median estimate at the moment. That can change as we get more estimates, but 140 is the median at the moment for Friday morning on a headline basis at 8:30 Eastern Time. Equities at the moment on the S&P negative by 0.5% with an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent said he's working with House and Senate Republicans to make the extension of President Trump's 2017 tax cuts permanent. Speaking to Fox News, Bessent says he's also working on the cuts President Trump promised during his campaign, including no taxes on tipped wages, overtime pay, and Social Security payments. U.S. automakers are making a last-ditch effort to push back on tariffs set to take effect this week. People familiar with the matter telling Bloomberg Ford, General Motors, and Stellantis are all asking the White House for exemptions on low-cost car parts. And SpaceX launched a mission funded and commanded by cryptocurrency investor Chun Wang to fly over the Earth's polar regions. The mission, carrying a crew of 4 private astronauts, will observe the North and South Poles and conduct research on the impact of spaceflight on human health over 3 to 5 days. That's your Bloomberg Brief. John?
Very cool. Yahara, thank you. Thanks for this morning. Equity futures right now in the S&P then just a little bit softer. Lots of data later this morning. Lots of data later on this week. So up next on our program, we'll set you up for the week ahead and the day ahead from New York. You're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Equities at the moment negative by 0.5%. We're down 0.4 on the Nasdaq 100 after snapping a three-day slide in yesterday's session. Couldn't avoid a big monthly loss on the S&P, the worst month for the S&P going back to 2022. The S&P 500 down close to 6%. Nasdaq 100 brutal, down something like 8. On the Russell, we're negative this morning by 0.4. In the bond market, the buying returns. Yields are lower by 4 basis points on 10s to 4.16. We're down 5 basis points on 30s to 4.52. And the next stop for this conversation, just an hour or so away. It's the economic data. Your trading diary looks like this. 9:45 manufacturing PMIs, 10 a.m. ISM, and JOLTS data at 3:30 later on this afternoon. The president signing more executive orders on Wednesday. President Trump's tariff announcement from the White House on Thursday. Auto tariffs taking effect and another round of jobless claims. Then on Friday, we get the March payrolls report, and you will hear from the Fed Chair, Jay Powell. What a week we've got coming up for you. Let's head down to the nation's capital and catch up with Laura Davison down in Washington, D.C. Laura, we've had some reporting already this morning about what we may or may not see in the next 24 hours. Help us put it all together.
Yeah, so today the White House is still deliberating exactly what this tariff plan will look like. We may get some more details in the noon hour when White House Press Secretary Caroline Leavitt will come out and take questions from reporters. Trump is also signing some executive orders this afternoon around 3:30. He could invite reporters in there, and that will probably be the last chance we see him before tomorrow's tariff announcement at 3 o'clock in the afternoon in the Rose Garden. No doubt the White House staff will be working overnight to get this all finalized. Also in the background, down the street at the Capitol, the Senate is looking to advance that tax cut package. Senators meet with Scott Bessent today and looking to have some votes later this week on that.
Laura, also happening in the Senate, they're expected to vote on this Democratic resolution that basically would block Trump using IEEPA for Canada. It'll go nowhere in the House, but it could take a gut check on where Trump is right now in terms of support from Republican senators that are a little bit uncomfortable with what's going on in terms of the trade between the United States and Canada. What can you tell us about this resolution?
Yeah, this will really be a litmus test to see, particularly on the Republican side, who is feeling anxious about some of these tariffs. We've had several senators come out and sort of brush aside, basically acknowledge, including the top senator, John Thune, saying he's not quite sure about the tariff policy, but hopes that whatever they can do in the Senate on tax policy will counteract that. Obviously, market's not happy with what they've seen over the past couple of weeks, and it's unclear, exactly how quickly and how big this tax package will be. That'll be the big question for markets and for the senators going forward.
This morning in Axios, they're citing a White House official describing the approach to taxes, saying this, quote, gun to the head, the whole agenda and the country's credit rating and global depression all rolled into one, AKA raising the debt ceiling into reconciliation. Laura, is it your sense that that is why they're pushing so hard to make sure that the debt ceiling is in reconciliation? Because they need these tax cuts ASAP to offset what's going on with tariffs? Yes, and this is really an implicit acknowledgement that Republicans have these very narrow majorities and that they basically have one shot to get everything they want to get done in one fell swoop. So this puts pressure on Republicans to get this moving forward. If not, a lot of people had worried that this may last till the end of the year, could really start to spook markets, investors, companies, and unsure if these tax cuts are coming. So having that debt ceiling baked in there, which looks like the default date will be sometime later this summer. It's possible that that gets shifted upwards if tax collections are slow. So it's a little bit of a live ball right now on exactly when they have to pass this, but it keeps the pressure on lawmakers, and that's what Congress needs to get anything done.
Laura, appreciate the update down in Washington. It's going to be a busy 24, 48 hours ahead for us all. Laura Davison of Bloomberg. Down in the nation's capital tomorrow, 3 p.m. You surprised it's 3 p.m.? Market's still open?
Well, he can be late, talk a little bit until 4 p.m., but yes, because right now you're going to have immediate knee-jerk reaction at a time where this market doesn't seem to be fully factoring in 20% tariffs, which is, according to the Washington Post, potentially on the table.
That's one of the proposals. That would be one of the most maximalist approaches, why everyone thinks he comes in with 20% on all these trading partners, then it opens the door for negotiation. Potentially it's at 3 p.m. because guess what? This might leak. Today there's a report that Jamieson Greer, the USTR representative, will give the president on the trade imbalances, and potentially that will dictate what he decides tomorrow.
We'll look out for those leaks overnight. 20% could change. That time could change. For some people, the damage is already done to sentiment, and we've seen that in the survey data. Will that show up in the hard data this week? That's the other big question coming into this week. It's not just about the tariff announcement. What will we see in the economic data, which concludes with payrolls on Friday?
And then Jerome Powell coming out and maybe not offering a sense of how much you support. On the flip side, some sort of reaction function from the Federal Reserve. Not only do you have the hard data, you also have the potential reactions from Republican congressmen, which I think will be very interesting. And it was something that you asked about, but you're starting to see that on the margin, some pushback. Senator Ron Johnson, it's a high-risk move. I don't know what his strategy is, as well as John Thune of South Dakota, saying he's very concerned about this. There is a feeling that if that sentiment shift does continue for long enough, you start to get a real response.
There's another litmus test, and that's elections today, special elections. I'm looking at Mike Waltz's former district. The Republicans had some 30-point lead, and now it's in single digits in terms of how much that lead is. It's not so much the Republicans might lose. It's how much the Democrats might be able to win back and what the margins are of that race to show that maybe people are a little bit annoyed. CBS poll over the weekend. They want the president focused on bringing prices down, not on tariffs.
Where are we going to be in 9 months' time? Are we talking about no tax on tips, on Social Security, on overtime? Are we going to make purchasing an American car tax deductible again? The Treasury Secretary says yes. That's the bigger challenge in the months ahead.
If you don't have especially that consensus in Congress, but this is what a lot of people are betting on. And the reason why, with all of this negativity that we hear, people are still talking about a price target that's above where we are now on the S&P 500. Why? Exactly because of that. The first half, tariff talk. Second half, he'll own the data. That, according to Howard Lutnick, and it's going to be some of the sweeteners, and that's what a lot of people were expecting coming into this year, whether it actually comes.
The opening bell, 34 minutes away. Tomorrow, your lineup on April 2nd looks like this. Mohammed Al-Arian of Queen's College, Cambridge. Andrew Hollenhorst of Citi. The former Trump trade official, Kellyanne Shaw. And former Obama economic advisor, Jason Furman. Looking forward to covering the story with you from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look at what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
One more day, 30 minutes until the start of the cash trade as we wait for tariffs. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, frustration and fatigue hit Wall Street. Investors are bracing for Trump's tariff rollout, the biggest risk confronting investors in years.
Meanwhile, automakers make a last-ditch effort to sway the Trump administration on those planned tariffs. This hour, we're also going to get sales for the automakers rolling in.
Plus, Howard Lutnick puts chip grants in limbo. The Commerce chief may withhold funding to push chip makers to expand their U.S. projects. All that and more coming up, but let's take a look under the hood at some stocks moving ahead of the opening bell. We start with Tesla rebounding a little bit ahead of those quarterly delivery numbers. We're expecting those out tomorrow. At the same time, Chinese rival BYD reported that sales were up 58% in the first quarter versus last year. Other automakers released sales data this hour.
And I'm looking here, Katie, at Vivid Seats, taking a hit this morning to the tune about almost 3.4%. President Trump's executive order to crack down on ticket scalpers, junk fees, and price transparency is moving them and their rivals.
I'm watching Johnson & Johnson after a judge rejected its third attempt to use bankruptcy as part of its talc cancer settlement. Separately, President Trump is planning tariffs aimed at the pharmaceutical industry, which has been protected for 3 decades by WTO rules. The president is set to unveil his global tariff plan tomorrow in the White House Rose Garden. The extent of his levies remain unclear, and he's offering few clues ahead of the reveal.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
And for the latest details, we're going to bring in Bloomberg White House reporter Skylar Woodhouse joining us now from Washington. You have the automakers trying to make a last-ditch effort to really roll back some of these threats. You have Trump aides coming to the surface with fresh proposals. What is the mood in Washington before this Rose Garden address?
Good morning. There's a lot of chaos going on right now in Washington. I mean, there's always something happening in Washington, but right now, the day before Liberation Day, as President Trump has been calling it, all of the different trade groups, officials, lobbyists, everyone is trying to make their final pitch to the White House, really, as they, sort of determine what the final plan for these tariffs are going to look like. Now, we've been hearing about these tariffs for a very long time now, and we are finally at the April 2nd marking point. And basically what we're going to see is, all right, are there going to be any 11th hour deals where maybe one group is exempt from these tariffs, or maybe one group gets higher tariffs? So much going on right now as folks look to try and lock down what really will happen tomorrow in the Rose Garden.
It seems as though the president's pretty clear that he wants to put on reciprocal tariffs that are as much as, but a little bit lower than the tariffs others charge us. Can we take him at his word on that?
I think with President Trump, you never know what you're going to get until he is at the microphone speaking. And I mean, we've seen with President Trump, we might think that one thing is coming down the pipeline and we see a Truth Social post that it is completely different from what maybe we were expecting. So I think the president, he's been swaying back and forth on this. We've heard that, maybe he would be more conservative, that he'll be more generous, but also maybe that things could be a little bit higher. So we really are on this swing right now as things sort of fluctuate to see where do we exactly land. Are we landing on the higher end or are we landing on the lower end? So it's only a matter of time until we see what the deal actually is.
Indeed, the countdown is on. Skylar Woodhouse, appreciate your reporting. And tune into Balance of Power for special coverage of President Trump's Rose Garden announcement on tariffs. Guests for today's special include former USTR Catherine Tai. Balance of Power will have extended programming today and tomorrow from 5 to 7 p.m. New York time. Meanwhile, Commerce Secretary Howard Lutnick is signaling that he could withhold promised CHIPS Act grants. Bloomberg sources say that Lutnick is pushing companies to substantially expand their U.S. investments. For more now, we're joined by Mandeep Singh. He is senior tech analyst for Bloomberg Intelligence. And Mandeep, of course, TSMC, their $100 billion investment pledge comes to mind. Are we likely to see more commitments of that type? Is this gambit going to work?
Yeah, look, when you look at the size of CHIPS Act, it was like around $50 billion, and it was announced all before, this whole AI wave came. And one of the things that we are noticing is obviously, the likes of TSMC are spending more on their CapEx, Samsung as well. And what I think the administration seems to be doing is focusing on making sure that these companies commit a significant portion of their CapEx here in the United States. So this is all bargaining tactics in terms of, driving the size of investments, similar to, as you mentioned, for TSMC and Project Stargate. So I expect to hear, more announcements like that.
Well, how significant will it be in forcing these companies to put more money on the table, given that we've already seen so many announcements already, billions of dollars toward AI spend? In other words, is this a big enough stick to come to the table with from the Commerce Secretary?
I mean, when you think about the cost of, constructing a fab, it takes anywhere from, 20 to 25 billions to construct a leading node fab. Now expand that to the overall ecosystem. You need, logic, you need memory, you need advanced packaging. And that's where, the numbers get bigger and bigger because the size of this AI market, one company is almost $3 trillion in market cap. So we're talking much bigger numbers now. And that's why I'm not surprised to see that, even a CHIPS Act $50 billion subsidy means nothing. Everyone is trying to think about bigger numbers, and that's where I think administration is going with this.
All right, Mandeep, thanks very much. Mandeep Singh there of Bloomberg Intelligence. Let's get to Intel now. The new CEO laying out priorities for the company, saying it will spin off non-essential assets to better align with customers and focus on retaining talent. Bloomberg Technology co-host Carolyn Hyde joins us now. So, Carolyn, Intel, obviously, one of the companies that would be most affected by any change in these chip grants.
Yeah, they're on tap to get about $8 billion was what was agreed with the Biden-Harris administration, but they were investing $100 billion into US manufacturing. Of course, they want to be more in the fabrication area of things, but more broad investment in the semiconductor industry. Now, $100 billion is a big commitment. A lot of this not only is about the grants, but it is about that 25% tax credit as well, which is so crucial to these companies. Looks as though Lutnick, of course, is thinking about how to enhance that yet further. But at the moment, Lip-Bu-Tan, yes, he's thinking about his investment. Yes, he's thinking about grants from the government. He's also thinking about his culture. He's thinking about his people. And actually, all the analysts out there liked what he painted at the Vision event that they just had in Vegas, because it's more right-sizing. It's not product roadmap. It's not big wishes. It's more under-promising, trying to say, I'm going to right-size on culture. I'm going to get the right talent in to take on the AI opportunity here.
Well, we talk about this so much. You have Intel, really an American treasure. If you have a lot of its rivals facing uncertainty, wouldn't that be even better for Intel while they're trying to make all of these big investments and maybe find some buyers for assets?
I think the real issue is right-sizing where they focus on from a product perspective, and they missed the AI trade. Gaudi, the offering they had, just didn't inject enough excitement in the market, and so everyone's still plowing into NVIDIA, maybe a little bit of AMD.
Gaudi is?
Their offering in terms of the accelerators, the AI accelerators that you can power forward in the data center offerings. They've got to get that on track. They've got to start thinking about their clients. This is what analysts want to see. How are they going to deliver to their clients when it comes to the foundry? And in many ways, some of these clients are indeed rivals. It's a frenemy organization out there. How are they going to be making chips for those rivals that at the moment are still in a quandary as to whether they're going to get chips funding too?
All right, Caroline, great stuff as always. Our thanks to Caroline Hyde, the co-host of Bloomberg Technology. Let's get a check on these markets right now. We have just over 20 minutes until the bells ring. We saw some window dressing at the quarter end yesterday. That lifted the S&P 500 out of its malaise, but you can see that we're right back to where we were, down about 0.3% on the big benchmark. Big tech also feeling the pressure, down about 0.2% on the NASDAQ 100. Also the Russell 2000 off about 0.2%.
Now, Katie, I want to bring you some breaking news as well, because Macy's is naming ex-Capri executive Thomas Edwards as its new CFO and COO effective June 22nd. You're seeing Macy's shares on the rise to the tune of about 1.2% pre-market. Remember, Macy's is a stock that has been down by more than 25% this year already, and more than 15% last year as well, Matt.
All right, coming up, the auto industry makes a mad dash to persuade President Trump to temper tariffs. We take a look at their pitch to Washington next. This is Open Interest.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Let's get now to high interest. Look at what's making headlines around the world. A federal judge is rejecting Johnson & Johnson's third attempt to shield itself from cancer-related claims related to baby power. The latest trust proposal would have set aside $9 billion for victim and used bankruptcy. Opponents say J&J should not be allowed to use Chapter 11 to resolve the cases and question the company's tactics in rounding up pre-bankruptcy support from victims. Brookfield Asset Management is agreeing to buy a majority stake in Angel Oak Companies. That's a mortgage lender, an investor that manages over $18 billion. The asset manager, Brookfield, will take a 50.1% stake in Angel Oak, offering its own investors access to the firm's residential mortgage credit business. Angel Oak will still operate independently. And China's BYD is posting a 58% gain in first quarter sales versus the same period last year. It's the nation's best-selling auto brand. It delivered 986,000 units in the first 3 months, of which 416,000 were pure electric vehicles. The numbers will likely be in stark contrast to U.S. rival Tesla, which only makes EVs and whose first quarter sales may be about 377,000, according to analysts' estimates. And staying on cars, Bloomberg is reporting exclusively that U.S. automakers are making a last-ditch effort to the Trump administration. They are hoping to get a tariff exclusion on certain low-cost car parts like electrical wiring, which are usually made in low-wage countries. For more, we are joined by one of the writers of that report, Bloomberg's David Welch, our bureau chief in Detroit. So, David, it looks like now components are going to be tariffed on top of the assembled vehicle tariff of 25%. Is there any thought that the Trump administration is willing to change that?
They might. There are a lot of discussions going on, top executives, government affairs executives, all talking to people in the Trump administration. What they want to do, they sort of want to kind of keep as much of the USMCA deal as possible. So with USMCA, if vehicles qualify the way the Trump administration has laid out the tariffs now, any non-U.S. content would get hit with a tariff. So you take something like a Chevy Silverado pickup truck made at the plant in Mexico. Probably half of that content is made in Mexico because the engines and transmissions are done down there and other parts like wiring and stuff like that. So, that's a $50,000 truck. Half of that value, $25,000, would be hit with a 25% tariff. The automakers are looking for relief on that other part that would be hit with tariffs. Because otherwise, even if a vehicle qualifies for USMCA, it can get quite heavily taxed when it comes across the border, and then they have to try to pass that on to customers. And we have the same issue we'd have with a vehicle that's made 100% in Mexico, Korea, anywhere else. It really makes even USMCA compliant vehicles in Mexico and Canada subject to very heavy tariffs.
Well, let's talk about the passing on of costs a little bit more. We heard from President Trump telling NBC over the weekend that, quote, he couldn't care less if they raise prices because people are going to start buying American cars. We're awaiting some of those delivery numbers, David. Are we expecting to see any of that pull forward behavior on the part of consumers?
Yeah, we'll probably see a fair bit of it. Just anecdotally, we've talked to a lot of consumers ourselves who've been kind of, in a mad scramble to buy vehicles before tariffs kick in. My mother called me last night and asked me if she should go ahead and do this. So I think it's happening in some, significant numbers. We'll see how much, and you probably won't know how much pull ahead there was until we look at sales in April, May, and June to see if they're down at all. But we're going to see some. We're definitely hearing that March was the strongest of the 3 months in the quarter. It traditionally is because the weather gets better and people actually go out and start kicking tires at dealerships. But All the data I'm seeing says it was a very strong March, and some people are definitely trying to head off tariffs and get out there and buy or lease while the getting is good.
I wonder why the big U.S. automakers, David, the big three, don't source more of their component parts in the U.S. Is it because they're internal combustion engines still for the most part? If we look at a chart of the average domestic content in U.S. vehicles, Tesla is able to source 81% of its component parts domestically, whereas Ford and GM only do 54%.
I don't think it has much to do with whether it's EV or internal combustion directly. Look, Tesla is a startup, and they vertically integrated a lot. They even make their own seats, which they didn't necessarily have to do. But I think a lot of the parts, batteries, engines, they do get battery components from overseas, but because it was a startup that had to kind of create their own ecosystem, their own supply chain in a lot of ways, I think Elon Musk's solution was always to look, if we can't find someone who knows how to do this quickly because it's relatively new, we'll do it ourselves. And I think also he didn't want to give some supplier a bunch of the profit margin. So they make a lot of their own stuff internally, and they're going to do it very close to their own factories because why deal with longer supply chains than you have to? I think when a company starts with a blank canvas like they did, you can do things like that. A lot of the components we're talking about that would be sourced in Mexico. It's wiring harnesses, very labor intensive. I talked to an executive at a major seat manufacturer yesterday who said stuff like cut and sew, right, for seat leathers and seat fabrics. That's very high intense, low value add, heavy labor kind of stuff. You have people stitching and sewing seat parts. Those are done in Mexico, and then because the wages are cheap, and then they ship them up to the U.S. and actually make the seat out of it. It's stuff like that.
David, I want to also point out we are getting some of the data out from the car makers via Ford, saying that overall retail sales rose 5% in the first quarter. March results drove a lot of that. It increased 19%. They're speaking to the sales of the F-Series growing 24%, and electrified vehicle sales totaling a record actually for Ford of 73,600, a little more than that in the first quarter, which is up 26%. I know we're looking through the numbers. You're talking to us here, but what do those numbers signal to you, especially ahead of more Tesla data tomorrow with the electrified sales?
So two things. With a strong March like that, that tells you that there probably was a good-sized group of people going out and buying vehicles in anticipation of April tariffs. People read the news, and they don't want to pay thousands more per vehicle. On the EV side of it, we saw it in the fourth quarter where people were worried about the tax credits going away, so they went out and bought. I think you might be seeing a second wave of that in the first quarter because, to the extent that people think that sometimes Donald Trump says things and talks a big game but doesn't do it, he's levying these tariffs. He has threatened to take away vehicle tax credits, and buyers might be saying, hey, if he's going to put a tariff on vehicles, and that's going to drive up the cost of an EV, maybe he is going to make good on his promise to get rid of Joe Biden's IRA tax credits, which could be as much as $7,500. So, do you want to pay an extra $3,000 to $5,000 in tariffs and lose a $7,500 tax credit? So an EV buyer might be extra motivated even compared to somebody buying an internal combustion vehicle.
All right, David Welch, great to get some time with you. That is Bloomberg's David Welch. Just to reiterate there, we are getting delivery numbers for Ford. The first quarter retail sales rose 5%, but first quarter total sales down about 1%. We're also waiting for GM today and Tesla coming up tomorrow. But before we get there, we have less than 10 minutes to go until the opening bells. We're joined by Allspring Global's Anne Milletti. She sees more volatility ahead. This is Open Interest.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, Ed Yardeni has cut his S&P 500 target for the second time in just 3 weeks. Yardeni lowered his target to 6,000 from 6,400. He spoke earlier to Bloomberg Surveillance about the absence of any clear policy for now.
I hope you're not looking for clarity for me, because I'm struggling with all the confusing information coming out of Washington. As you said, you're getting different messages from different people in the administration, and at the end of the day, it'll all depend on what the president concludes he wants to do that day, and he could change his mind again.
Joining us at the desk now is Allspring Global Investments Head of Equity, Anne Milletti. Anne, it's great to see you in person.
Thanks for having me.
So Yardeni is just one of a whole parade of sell-side analysts that we've seen cut their targets. We finally broke below 5,500 again yesterday, retesting that low of the year. We closed back above it. Do you think that we've really seen the bottom, though?
I think we have a little bit more to go. I don't think uncertainty ends, even with tomorrow. I mean, you know, everybody's waiting, trying to get clarity. I don't think we're going to get perfect clarity tomorrow. I think we're going to get the start of what we think this looks like, but likely a lot of change even after tomorrow.
What do you think? What do you think still needs to be reduced in terms of, you know, valuations?
I think, you know, I mean, the old saying of companies adjust is absolutely true, but you have to know the rules to the game. And, you know, the rules are unclear. And if you don't know what the tariffs are going to be, if you don't know what your costs are really going to be as a company, it's really hard to manage your book of business. And so, although, you know, I talk to our portfolio managers all the time, they're not getting a lot of, you know, CEOs and CFOs are not frightened necessarily, but I think they're just waiting. They're waiting to see what, you know, they can do, and that affects CapEx spending. It certainly affects hiring. We're not at the point where we're worried about, you know, layoffs yet, but if, you know, we don't see clarity by the end of the year, I think we will, that will come into play as well.
CEOs, investors, consumers, the list goes on, just waiting for clarity here. And we are just getting started. Hold tight for just a couple of minutes. Anne Milletti is staying with us at the opening bell. Futures on a downdraft as we count down. That is coming up next. We'll walk you through all the action. This is Open Interest.
asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
We are moments away from the start of trading, the day before the big day. This is Bloomberg Open Interest. I'm Matt Miller, and we're looking at futures that are down, although not big drops after we closed up yesterday on the S&P 500. As Katie said, a little bit of window dressing there. We see futures down about 0.25%, and we were at one point yesterday at 54.88, so below the 5,500 level before that recovery. NASDAQ futures down a little bit stronger, about 0.4%. Russell 2000 futures down 0.3. At the New York Stock Exchange, GoDaddy is ringing the bell, and I took a look at, as I always do, at the comp chart over a 5-year period. If you bought that stock and reinvested dividends, you are a happy camper because it's up 240%. Down at the NASDAQ market site, we have Sanofi ringing the bell together with We Are Ill. Not in the New York kind of Beastie Boys sense, but in the medical sense. They're trying to change the way we perceive of sickness caused by MS. Now, in terms of the stocks on the move, let's get over to Katie Greifeld. Katie, what are you watching?
Well, there's a lot of health names in the red right now, of course, a lot of headlines around the pharma space in particular, but I'm keeping an eye specifically on Johnson & Johnson. That's after a judge rejected Johnson & Johnson's third attempt to use bankruptcy as part of its talc cancer settlement. Separately, we also had President Donald Trump planning to impose tariffs on pharmaceuticals. You add it all together, Johnson & Johnson down about 3% right now.
I'm looking here at an up arrow story in this tough market here. Macy's, they've hired Thomas Edwards, who is an executive from Capri Holdings. He's going to be Macy's new chief financial officer and chief operating officer. He's going to join Macy's on June 22nd and replace his current CFO and COO, Adrian Mitchell, who will leave the company on June 21st. Macy's up now about 2.5, nearly at the market open, Matt.
All right, Tesla, we've seen rebounding in the pre-market. It's doing the same thing in the cash trade. Quarterly sales data for Tesla is out tomorrow. We just got Ford saying they sold the most pickup trucks in March that they ever have in a month as consumers pull that forward. Rival BYD in China, by the way, sold a lot more cars than Tesla is expected to. BYD selling almost 500,000 electric or hybrids, and Tesla is slated to sell 377,000, at least according to analysts. We are back with Allspring Global Investments head of equity, Ann Moletti. And Ann, we're looking at some fallout in the markets from the expectation of tariffs. How do you think traders should play this? I mean, we don't know what Trump is going to say until it comes out of his mouth.
Yeah, look, traders will play it on the short term, but we're really focused on the long term as investors. And we do think that this will cause disruption that will lead to opportunity. And so one of the best pieces of advice I got from one of my mentors was to listen for the quiet. And when I talk to the portfolio managers that I work with every day, what they're talking about now is where the opportunities lie rather than where the risks lie. And I think that's kind of the reversal of where we were last quarter, where we were like, okay, let's think about the risks while everyone else was thinking about opportunity. And I think there really are underlying opportunities. The market is breaking away and changing from one of concentration, momentum, some speculation, to one that's very focused on the fundamentals, very focused on the companies that can, continue to do well and control their own destiny through what's going to be a bumpy ride.
Speaking of bumpy rides, I want to pull up the sectors of the S&P 500 because it's not all red for the year. There is some green on the screen, though even some of the favorite trades have turned around. Yeah. Are you finding any opportunities in the places right now that investors are still looking to hang on to? Energy is leading the pack. A lot of defensive sectors, healthcare, consumer staples. Do you get in?
So I do think defensives, as we knew them in the past, are now becoming defensive again. And the reason why I state it that way is a year ago, people would have said the defensives were the Mag 7. And really what they truly are and historically have been are utilities, staples, REITs, an area that has more steady cash flow and dividends, and they're acting like that again today. And so I think those areas of the market are attractive. I do think certain areas within healthcare, primarily diagnostics and med devices, are areas that will, present opportunity. And natural gas, especially within energy, is kind of a key focus area for a lot of our PMs.
Well, let's focus in on healthcare. It's interesting to hear you name that. Of course, healthcare is your second best performing sector of the year, but one of the most read stories on the terminal right now is President Donald Trump planning to impose tariffs on pharmaceuticals that could lead to higher prices. Pharma is just one slice of the healthcare industry, but I would imagine that has ripple effects. How are you factoring that in?
It does have ripple effects, and look, you have to be careful when you play the healthcare space. But more broadly speaking, if you look at the underperformance of the healthcare space over the last several years, it's been due to the underutilization post-COVID. It's also been, kind of perceptions about what these weight loss drugs, maybe it's partly perception, partly reality about what some of the GLP-1 drugs will do in creating potentially a healthier population going forward. And so utilization trends, all of that pulled back. Valuations pulled back a lot as well. Underlying that, there's still really good innovation within healthcare. And I think that's why the diagnostic space and the tool space, you'll continue to see good innovation that investors will pay for and that, will be willing to pay for going forward. And so I would be selective. Pharmaceuticals did run up with the surge and what we saw in utilization of pharmaceuticals over the last few years. So it's not a favorite area.
It's such a broad space, right? There's a difference between CAT scan machines, which we're always going to need, and like biotechs, which is like putting everything on red 21. I want to ask about the consumer. I noticed that the subprime borrowers, we have now higher delinquencies than we have since the beginning of 2020. And we're looking at bank balances that are lower, debt that is higher, across all income levels, real problems for the consumer. How do you see the consumer affected by these tariffs?
I mean, they are affected. They've been affected by inflation over the last several years, and particularly the mid to lower end consumer has been really challenged. And now the impact of potential inflation on top of that will make it more difficult. I think the most critical thing that we're watching is jobs, because consumer confidence has kind of plummeted. They are still spending, but if jobs do roll over in the private space in particular, that's going to be problematic. I do worry a little bit about the retail space, and margins are thin there. If tariffs do have an impact and if demand is hurt at all, it's going to be an area that could be a little bit more challenged than some other areas.
I'm glad you made that point earlier about the energy trade also. I think this ties kind of nicely together because you're worried about the consumer, but yet energy is being bid up. But if you're worried about the economy, then does that make sense? And I'm wondering whether even some of those defensive areas of the market have perhaps gotten a little too hot?
Yeah, there certainly are. And I think this is where, again, active management kind of comes into play, because it's easy to broad stroke any industry and say this is bad and this is good. But oil acts very differently than natural gas, for example, right? And the tariff impacts and maybe extra penalty impacts that we're hearing about in oil will not necessarily affect natural gas. And so really picking through the energy space is important. Same with healthcare, industrials, et cetera. You know, watching where government contracts are as government spending gets reduced is also going to be important, and one of the things we're looking at. So we're kind of back to bottom-up fundamentals and really making sure we're paying attention to those rather than just the broad macro issues.
All right, that's a good place to leave it. Always great to see you in person. Such a treat. That is Anne Milletti of Allspring Global Investments. Let's get a quick check on these markets, because the S&P 500 down at session lows, now down 0.5%. Those window dressing flows from yesterday seem to have wrung themselves out of the market, though I will note volume pretty muted right now. Let's take a look under the hood and see what's moving now with Bloomberg's Nora Melinda.
Well, Katie, lots moving under the hood this morning. I'm keeping an eye on airlines companies. We saw Jefferies that downgraded a swath of these companies this morning, and we are seeing them tumbling. This is more on the outlook about the consumer and what the outlook seems to be for corporate spending. The analyst is saying that Delta is likely to cut its annual forecast, but they do expect that American Airlines and Southwest Airlines must cut their annual forecast. We do have Delta earnings that are going to be reporting next Wednesday. They'll be the first to kick off the company's earnings, so that'll be lots to keep an eye on, but also keeping an eye on Intel. So shares were earlier in the green in pre-market trading, but they are since now declining. But analysts were encouraged by the new CEO's messaging during a keynote speech at Intel's Vision 2025 event. They said that he had a candid tone, and he really focused on the idea of rebuilding consumer trust as well as rebuilding engineering. But analysts are still saying that any successful turnaround for the company will take at least several quarters, and it will be difficult to execute. Last but not least, I wanted to keep an eye on a name that's in the green. I'm keeping an eye on PVH. It's the owner of Calvin Klein and Tommy Hilfiger. We're seeing shares up for double-digit gains. They're expecting sales growth to be flat or slightly positive this year. This is different from what the street was expecting. They were expecting about a 0.5 percentage point decline. Evercore is saying that some of the company's initiatives are starting to stabilize the business, but we do have the stock that is still down almost 40% this year.
Nora, thanks very much. Nora Melinda there talking us through a couple of the stock movers. Coming up, the Trump administration targets ticket scalpers and fees on tickets, sending shares of companies like Vivid Seats lower. Details on that executive order next as stocks fall 10 minutes into the session with the S&P down now more than 0.5%. This is Bloomberg Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
It's
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, welcome back to Open Interest. A quick check on stocks. We're a couple minutes into the session. You can see that the S&P 500 not quite at session lows, but still having a pretty rough Tuesday, down about 0.3%. Big tech is actually your outperformer right now. We haven't seen that for a while. It's the small caps that are really leading this sell-off. The Russell 2000 down about 0.7%. There's a bullish case out there that these companies are more domestically focused and that they should be more insulated from those tariffs, but you're not seeing that logic play out today. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Shake Shack getting upgraded to a buy over at Loop Capital on its earnings upside. The analyst also says that Shake Shack has minimal risk to those tariffs since it sources nearly all of its ingredients domestically. That's good for a 2% rally. Next up, Ulta getting raised to a buy over at Goldman Sachs. Analysts say that the beauty industry has likely reached a bottom and that Ulta is seeing an uptick in sales. And finally, we have Keurig Dr. Pepper getting raised to a buy over at Morgan Stanley on its growth potential. The analyst also says that, quote, the worst is over when it comes to coffee prices, Matt.
Thank goodness. I'm glad the worst is over there. President Trump signed an executive order alongside Kid Rock. Kid Rock was in the Oval Office, and he was dressed like that. That's not a joke. This is real life. We're reporting the news on what's happening in Washington, D.C. In any case, this order is designed to crack down on ticket scalping and fees that drive up the costs of attending live events. It orders agencies to promote competition and ticket price transparency. Shares of Live Nation are actually up right now, and shares of Vivid Seats are down. Bloomberg's Akela Gardner reported on this and joins us. And Akela, you know, it seems like people in Washington, starting with John McCain, have been making noise about this for as long as I can remember, and yet nothing ever happens. These ticket vendors are still ripping us off every chance they get. Do we have hope now?
Well, President Trump certainly hopes that they do. He signed this executive order yesterday, as you mentioned, in the Oval Office alongside Kid Rock, someone who has been a fervent supporter of the president and campaigned with him. And he really talked about musicians don't really see the profits that a lot of these ticket resales have, these added fees that many of these companies add on. But this was also something that President Joe Biden did in his time in office. He called this junk fees, quote unquote. And we saw some companies like Ticketmaster, like SeatGeek, take steps to really show all-in pricing. President Trump is also pushing for those companies to do that as well. He's specifically asking the Federal Trade Commission and the Justice Department to really enforce competition laws. They also ask state consumer protection authorities to take a step up here as well. But this really comes at a time where he's really struggling with his perception on inflation, on the economy. He has good points when it comes to immigration, but that was a huge issue that he campaigned on, and we're seeing consumer confidence really down, of course, volatility in the market, and this is really an area that people feel and Republicans feel that he hasn't paid enough attention to.
Yeah, you know what's pretty fascinating to me? Not only are Live Nation shares now higher on the day, they are higher on the year in a market that's been broadly down. They have been soaring really the last couple of years. You don't see the same for Vivid Seats. It's gone the other direction. Given that both administrations have had such a strict stance on what's been happening here in terms of ticket pricing, is this the kind of final move, or is there still a pathway in which there isn't more of a crackdown on these fees and on these prices?
Well, the president does ask agencies to come up with a report in 180 days, but we're really going to have to see if these companies make any changes. Like I said, some of those companies have already made major moves to show more transparent prices. Perhaps Vivid Seats will get in there as well. But President Trump is certainly saying that this is something that he's going to look at broadly. And at the end of the day, he's also looking at things like no tax on tips. So he's certainly trying to show that he's looking out for the little guy, for consumers. And there's really a lot of pressure on him to do that, particularly as he's talking about these tariffs. And there's a lot of concerns that those are going to eventually raise consumer prices as well.
Okay, Love, we thank you so much for all of your reporting. That is Kayla Gardner of Bloomberg News. Now, we want to bring you some breaking news as well, because, of course, we are getting data throughout the hour, including manufacturing PMI, where the reading was actually a little bit higher. You're looking at a 50.2 reading versus, I believe, 49.8 that we had been looking for. We are looking at the S&P 500 now. It's been reacting throughout the morning. It is barely down now, pretty much flat on the morning. Remember, we have more data still coming up, including JOLTS at the top of the hour, including more ISM data.
Yeah, the NASDAQ 100 turning positive, big tech leading the way here. Looks like the S&P 500 isn't too far behind, but it's hard to really get a read on these markets and look at any move with any conviction right now when we know the big day is coming tomorrow, Matt Miller.
Yeah, and it won't even be until the afternoon, right, that we actually get these announcements.
Didn't we have a countdown clock? It was like 1 day and 5 hours.
Let's bring the countdown clock back.
I mean, the hard thing is it's not even just tomorrow. If we're looking at all the economic data, you have traders reacting, but it's Friday also with the JOLTS, the jobs data. That could be another big point to look at in the week.
Yes, every other day there will be some important thing for the market to move on, even every day in this administration. But maybe we can just look forward to 11 minutes from now and we'll get the JOLTS data. We're going to bring you that with Mike McKee, I believe.
Yeah.
So you'll see job openings. Neil Dutta sent out a message this morning. Job openings continue to decline, and that's just one more concern for consumers.
Certainly something to keep an eye on, as are shares of Newsmax.
Yes, we're going to be looking at that next. It's crazy. We've seen some IPOs in this market. Retail investors are riding the wave, particularly for Newsmax. As Katie was saying, the stock has been soaring after its initial public offering. We'll take a look at that next. This is Open Interest.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
This is Bloomberg Open Interest. Get a check on what's going on with stocks right now. Kind of evening out in terms of the S&P 500. We were off more than 0.5% a few minutes ago. Now we're only down 0.2%. The NASDAQ 100 down even less. Take a look at some of the movers here. NVIDIA, obviously a huge drag. If it moves more, it could sway the indexes. Tesla actually up 2%, which I think is interesting. They don't have their sales figures out till tomorrow. Ford sold the most pickup trucks in a month ever in March as demand was pulled forward. General Motors, you can see, down about 0.5% here. This is, to me, one of the most interesting and would be infuriating to me if I were an owner of Newsmax shares that hired an investment bank to sell them for me in an IPO. If I give you something for $10 and the next day someone is paying $125 for it, I want to know, where's my cut, Shanali? That would make me very, very angry.
Oh, we are going to get so into it, Matt, because it's a tale of two IPOs. Newsmax is surging in the IPO debut, while CoreWeave has struggled since its downsized IPO. We're going to break down both stories with Bloomberg's Bailey Lipschultz. Okay, Newsmax, let's just start there to Matt's point here. It priced at $10. It's trading at nearly $130, 13 times higher. Didn't hire a major Wall Street bank, hired Digital Offerings LLC. Really interesting move there. What is going on?
Guys, we see this from time to time with tiny IPOs. $75 million is pennies relative to bigger banks. When we look at some of the data, and we had a chart in our story yesterday, we had a number of companies, about 24, when you go back in the last 5 years, that popped more than 300% in their day one IPO. So we're talking about companies, Matt, maybe you've never heard of: U-Power, Molecule Group, Newton Golf Company. My favorite is Adentax, was up 13,000% day one.
I think it's a Dentax.
A Dentax, okay.
No, I have no idea. I have no idea. I've heard of none of those.
It sounds official, but all of those pretty much down 100% from the peak. This does happen. There is maybe a retail meme flavor. We are seeing the likes of kind of chatter on StockTwits. We've seen it popping up on Fidelity's platform among their top 25 most bought companies. You do have scarcity value, so it's not a big float. Not a lot of shares out there. If you bought it at 10, you don't want to sell it yet. And if you're on your Robinhood app trying to get orders in, you're just market buying.
And, you know, to Matt's point here, because they didn't hire Goldman, maybe since it's a small IPO, they saved a little money there in terms of the public offering.
If you don't hire the bank that's paying $80 million to its CEO and COO.
I'm sure that some of the bankers at Goldman are watching this and chuckling a little bit. But I want to talk a little bit, too, about just the types of IPOs that we're seeing in terms of size specifically, because you have Newsmax, you have CoreWeave, which, by the way, is up today, even though it had a pretty rough debut last week. These are smaller companies. They're not tiny, but they're not huge either.
Well, it's very much a divide, right? So when you look at year to date, we have 3 IPOs to raise more than $600 million. CoreWeave, one of them, at $1.5 billion. So that is what we would call a blockbuster IPO, one of the biggest IPOs, biggest tech IPO since ARM in late 2023. But to your point, with a lot of these small deals, that's when you see stocks swing wildly. So they're very much different in that way. Obviously, their banks are different. The buyers who are trading this are different. I think that if you talk to a fundamental investor about CoreWeave, the thought is the long-term thesis. If you're talking to someone who's buying Newsmax at $130, I'm going to assume they're hoping that someone wants to pay $200 for it.
Greater fool.
But that's kind of where it's at. And it has shades of meme stocks, but also of kind of D-SPACs that we've tracked.
Bailey, great to have you on because you covered all that stuff for us. When we come back, we're going to talk about the economic data in the next hour. And Jim Tannenbaum joins us of Foresight Capital.
is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focus on violent crime, and now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Wendy Gillette. Another federal agency is getting hit with layoffs today. This time, the Department of Health and Human Services. Up to 10,000 workers could lose their jobs. CBS's Alex Tin.
Notices began to be mailed out early Tuesday morning to thousands of workers at public health agencies throughout the Department of Health and Human Services, notifying them that they would be laid off as part of Secretary Robert F. Kennedy Jr.'s restructuring of the department. In many parts of the department, entire teams and divisions were cut as part of the changes, and several senior leaders, including the FDA's top tobacco regulator, Dr. Brian King, were also put on leave.
Vice President J.D. Vance is defending the deportation of a man from El Salvador who had legal protection, saying he was an MS-13 gang member. CBS immigration reporter Camilo Montoya Galvez on his status.
In 2019, an immigration judge granted him something called withholding of removal, which is a legal protection from deportation for people who are found that they are likely to be persecuted in their home country if they are deported.
There's not much notice as President Trump plans to announce reciprocal tariffs tomorrow. Georgetown trade expert Jennifer Hillman says that's problematic.
The Customs Service needs to plan for what goods are they imposing tariffs on. The importers need to plan for what documentation they need to require.
The most expensive judicial race in U.S. history is unfolding today in Wisconsin, deciding the balance of the state Supreme Court. CBS's Tareen Small on its significance.
Ultimately, the fate of the Democrat who is governor there, his agenda is on the line there, as well as ultimately any injunctions that we could see come out if any of Donald Trump's executive orders or actions are challenged.
Tens of thousands are still in the dark after a major storm hit parts of the Midwest. Some gas stations in lower Michigan are still waiting for the power to be restored. Michigan State Police Lieutenant Kim Vetter.
We're trying to keep emergency vehicles on the roadways with the gasoline that is available. So if you can, just hunker down at home, grab some blankets, start a fire if you have a fireplace, read a book, keep people entertained, but stay home, stay safe.
The women's Final Four is set. UConn, Texas, UCLA, and the defending champion, South Carolina, leading the past 2 seasons with only 3 losses. Chris Vanini covers the tournament for The Atlantic.
South Carolina, they've been such a dominant team
recently, despite, lots of turnover. I mean, last year's team that went undefeated and won the national championship, they had lost 5 players to the WNBA the year prior.
Stocks are down. This is CBS News. There is a court ruling in the South on abortion.
A federal judge says Alabama's attorney general cannot prosecute people and groups who help Alabama women travel to other states to get abortions. The judge sided with an abortion fund and medical providers who sued State Attorney General Steve Marshall. Marshall has suggested that conspiracy laws could be used to prosecute people who help Alabama women go out of state for abortions. There have been no prosecutions up to now. Alabama bans abortion at any stage of pregnancy with no exceptions for rape and incest. Steve Kathan, CBS News.
Investigators in Costa Rica say high levels of carbon monoxide were found in 14-year-old Miller Gardner's hotel room. The American teen was vacationing with his family, including father Brett, a former New York Yankees player. Miller died March 21st. Toxicology tests are still pending. Wendy Gillette, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Here's economic data out here, ISM data we're going to get to in just a moment. It looked weaker than expected, so we'll break that down in just a moment. We're going to check in with Sarah Ponsek. She's a financial advisor at UBS Private Wealth Management. What is she telling her clients these days? Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, on whether the tariffs add enough to inflation to lead to rate hikes in a recession. That's kind of one of the fears out there about this unknown. Right now, let's go to Tim Fiore, break it down. He's the chairman of the Manufacturing Business Survey for the Institute for Supply Management. Tim, talk to us about this ISM data. The manufacturing headline came in at 49, below the consensus and below last month.
Yeah, I think we're disappointed here, but there's no huge surprise to this. I think the important thing is, after I looked through all the data, I had to step back and say, what am I seeing here? And essentially what you got here is, we're not sure what to do, and we're so confused. So if you look at the three elements, outputs, demands, and inputs, this PMI is being supported again by the input strength, which is really being driven by the tariff issue. So if you remove that out, this month would have been about a 48.3, just like last month would have been a 48.3. Our demand is still non-existent, really, because we're waiting to make investments. But I think the biggest story here in this month's report is that revenue is down this month. We're continuing to destaff, and it's all being driven by the uncertainty around the near term, the moderate term market development as tariffs get deployed. The good thing is tomorrow should shed a lot more light.
Mm-hmm. Yes, well, maybe. Tim, to that point, if this uncertainty persists, what's the end result to that? Like, is it more destocking? Is it more layoffs? Is it less investment? Like, or is it just deferred?
Well, so our inventory number will drop because we're probably trying to get 2 or 3 months worth of inventory in hand here to avoid the first hits of the tariffs. But I think it's becoming clear now that these things probably aren't going to go away. So what's going to happen is that it's going to limit our willingness to invest in capital. We are investing in inventory, as you can see, but we're not investing in capital goods to replace capital, to expand capital, R&D capital. That's really all on hold here until this whole thing settles out. Here we are one day before a major day, and we're still not sure of the details. So a lot of uncertainty here. You know, the markets, the manufacturing does not like uncertainty. We're in the middle of the uncertainty here. We're going to need a little bit more time to see where this goes. But in the meantime, you know, I think this would have been a 48.5, 48.3 if you normalized for normal behavior here, which right now we don't have. So we did disappoint. I think we underperformed 49. I think the average was supposed to be 49.5. Not a huge difference. You know, we're not collapsing here, but we're still reducing our revenue and reducing our head count, which in the moderate term may not be good in any kind of recovery cycle.
All right, Tim, thank you so much for joining us. Tim Fiore, chairman of the Manufacturing Business Survey Institute for Supply Management. Again, the ISM headline data, the manufacturing data came in at 49. The consensus was 49.5. So anything below 50 means a contraction in the manufacturing economy. The ISM prices paid surged to 69.4, well above where folks were looking. And employment remains weak, and actually weaker than expectations. So some issues there in the manufacturing sector as well. All right, right now, let's go check things out on the market, get a data check here with Mr. John Tucker.
All right, the Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Yields on the two-year treasuries, they were a little changed before the latest economic data. Right now, down over 3 basis points, 385. I mentioned this because it's more policy reactive. The 10-year, that is down 6 basis points. That is at 414. The ISM new orders and employment indexes are showing a deeper than expected contraction. Also, at the top of the hour, the JOLTS, the Job Opening Labor Turnover Survey, that coming in weaker than expected as well. And we're getting this reporting from the Washington Post saying, with few exceptions, tariffs will start at 20% tomorrow. So that all weighing on the major stock indexes. The S&P 500 right now down 35. That is down 0.6%. The Dow Jones Industrial Average now down 392 points. The NASDAQ 196 points lower. That is down 0.5%. Earlier today, speaking to former Fed Vice Chair Richard Clarity, he says it could be years before tariff benefits, if any, actually show up.
Right now, what you're getting is a lot of uncertainty. It's slowing the demand in the economy. Eventually, you may get more jobs and more production, but that's several years down the road. So I think I want the folks in the Oval Office to understand the time dimensions at work here.
Let's do a meme stock, or what has become a meme stock, Newsmax. Shares are soaring a day after their initial public offering. Newsmax, the bottom line, $171 million in revenue last year. The shares right now are up another 92%. The company's market value in the multi-billion, something like $16 billion at a last count.
Bringing it up.
Media's coming back, baby.
Well, maybe. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Welcome back.
Thank you. Happy Monday. Just kidding. It's Tuesday. Alex Steele here alongside Paul Sweeney and John Tucker. Good to be back. Missed you guys. This is Bloomberg Intelligence Radio. I want to take a look at some stocks on the move today. We're joined now by Bloomberg's Isabel Lee, Bloomberg Cross Asset Reporter. Let's kick it off with Shake Shack.
Shake Shack, so the stock is edging higher by almost 1%. Loop Capital Markets upgraded the stock to buy from hold thanks to the recent pullback in shares and also the potential upside for the company's earnings. So we have analyst Alton Stump saying that there is potential for 10% plus upside to management guidance. He sets a price target at $127. Now it's around $88. So that's around a 44% increase from the closing price. And he adds that the recent pressure in shares has created an attractive buying opportunity. So the stock has slumped around 32% so far this year. So that's also from its December peak. It's even more at around 37%. So that's exactly what he was saying. But Shake Shack has 13 buys, 12 holds, and 1 sell.
People love the Shake Shack.
I like the burgers.
I've never eaten there, but they do really well.
Alex.
No, I mean it's burger. I love burgers, but you know.
All right, we'll go down one day after the show to Madison Square Park. We'll eat outside in the park in the Shake
Okay.
Shack. That's where you go.
I'm gonna have this. I'm really looking forward to the shake part of that whole thing.
Yes,
Johnson & Johnson also on the move today. Tell us what's happening here.
It's in the opposite direction, edging lower by more than 5%. So a federal judge rejected the company's third attempt to use bankruptcy to set up a multi-billion-dollar trust fund to pay women who claim they got cancer using baby powder. So I used to use a lot of baby powder when I was young, and I did admit I got a little bit scared. So J&J was trying for the third time to use a small unit to resolve this talc-related lawsuit involving ovarian cancer and other gynecological diseases. And so obviously the judge rejected this.
This is obviously a real thing, but I just kind of, is it still on the shelves?
No, I think it's more just like how they're going to pay for it. I think he's trying to figure out how they're going to settle these kind of lawsuits.
Are people still using this product?
You can still have baby powder, but clearly, like any issues that may or may not have been there, they're going to definitely go in and fix. This is just in terms of the settlement and how they're going to wind up paying for it because they're so big.
Yes, and the latest trust proposal would set aside $9 billion for the victim.
All right.
So,
and it's substantial, and sort of how to navigate that. Let's wrap it up again. Here we go with Newsmax.
This is honestly eye-popping. So Newsmax shares skyrocketed 700% in the debut session. Now it's still edging higher by 92%. And a lot of that is because of individual investors. So they piled in to the conservative media outlet after its IPO. So the company sold $75 million of shares at $10 each. That's on Monday's IPO. And really, investors piled all in. They're among the 30 most actively traded on Fidelity's platform. And this is just in stark contrast with the lackluster and kind of like the, I don't want to say lame, so let's just say not exciting IPO we've seen with CoreWeave and Venture Global. So it's interesting. And another fun fact, the 6-year-old co-founder and CEO, Christopher Reddy, now commands a fortune of $3.3 billion.
Yeah, I mean, I would
Digital
definitely.
Offering LLC was the lead manager. Digital Offering
that's
LLC.
interesting.
I don't know
MA,
them.
you taught me that function, MA Go.
Yes. I don't know who they are, but there they go. They got this big deal out the door, and people are buying it.
But you make the point that it's been very difficult when it comes for IPOs this year, despite, like, you think that an AI infrastructure play would do really well, but as you mentioned, it really hasn't at the end of the day. All right, thank you so much. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. So I'm looking at the market here, guys.
Yep.
It's still grinding lower, but I don't necessarily see any big step down after the manufacturing data or the jolts. It just feels like, how do you find direction right now?
Yeah, I think direction. People think about tomorrow as when we get more information from the administration regarding the tariff policy, that it may be a clearing day for the market.
Yeah.
And that could go either way. It could be, oh boy, these are more than we were anticipating, which case perhaps a leg down, or it could be maybe a little bit better than the market was discounting, or at the very least, we now have some visibility. That may be a catalyst to kind of spark the market higher. So again, I've heard arguments for both about how tomorrow's could be interpreted by the market. And again, I think that's going to be, I think the announcement, I saw some reporting 3 p.m. East Coast time tomorrow.
Which will be during the close show. So stay tuned because I will be there. And I should point out that we definitely did see a move lower with the S&P when we did get that data. But I just mean over the last couple days, it feels like we've been trading pretty heavily. I think the question becomes is, will it be a clearing event in that are we seeing correlations pick up? And the thing is, we're not. So when you see correlations pick up, it usually means you're feeling a lot of fear and anxiety in the markets and things are moving together. We're not seeing that right now. So are we even set up to be a clearing event? Or do we need even more sell-off within the equity market to kind of get to that point versus, say, an individual sector rejiggering or rebalancing? I think it was Morgan Stanley saying that it was time to get out of industrials due to the tariff situation. Is it more that part?
It's interesting. We had Richard Clarida on the start this morning around 7 a.m. on Bloomberg Surveillance, and former vice chair of the Federal Reserve. And he says he has no idea what's going on. He's waiting. I mean, and he's got, presumably some pretty good data, some pretty good sources within the government to kind of give him a sense of how things are playing out, and he's waiting. And I suspect, we looked at some of this ISM data that we just went over with good folks at the ISM. Looks like the manufacturers are waiting too. I'm not going to, add to employment or, add to my manufacturing capacity right now, and at least figure out what's going to happen.
And also, the whole inventory picture has really changed since COVID, right? Like, no one's stockpiling inventory anymore. So it's more like a just-in-time inventory situation. So even if you wanted to import a bunch of stuff now to get ahead of the tariffs, like, can you? Like, do you have the labor? Do you have the facilities with which to do that?
Yeah, I feel good about buying that car a couple of weeks ago because I don't know what is going to happen to the car price.
Who made it,
I
by the
leased
way?
it for 3 years. What's that?
Who made it?
Honda, and it's a hybrid.
I think Honda's okay because I think Honda has a lot of factories here in the U.S.
Yeah, I don't know.
But you know what? Let's research that. John Tucker is on the case. All right, coming up, Sarah Ponzik will be joining us over at UBS Private Wealth Management for her outlook on the market. And Ira Jersey, Bloomberg Intelligence on bonds.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash ahead of President Trump's tariff announcements tomorrow. The Washington Post reports the tariffs are going to start at 20%, and they say with few exceptions. We got the data just to rehash the manufacturing ISM survey, slightly weaker than expected. That was on the headline basis. But dig down deeper, some concerning details. The prices paid rose to the highest level since June of 2022. New orders and employment were both lower than expected. The headline number indicates contraction. It was below 50. That's the dividing line. As you look at stocks right now, all 11 major industry groups in the S&P 500, they are down. Healthcare and financials, right now, they are the biggest drags. S&P 500, 44 points lower. That's down 0.8%, 55.66 on the index. Right now, the Dow Jones Industrial Average down 428 points. The NASDAQ 100, 150 points lower, and that is down 0.8%. 2-year yield, 3 basis points lower as investors seek out the safety of treasuries. Right now, 3.85% on the twos. The 10-year is down close to 7 basis points, and that is at 4.14. Okay, so it was a hybrid CRV.
Yep.
It was either made in Marysville, Ohio.
Okay. Sounds
or Greensburg, Indiana.
Aha, so local.
Well,
so I bought local.
Yeah,
You did. You did buy local, even though it was a Honda. And I love that you actually looked that up.
Yep.
This is why I love you.
Hybrid technology.
I went to Google and searched it. I don't know if it's accurate. That's
I
what
forgot
they say.
I even asked you to do that 4 seconds ago. So this is, nice job. So you did buy, even though it wasn't like a U.S. company. So go figure.
Yep.
All right, thanks so much, JT. Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. And we also like updating you on the view outside of Bloomberg. Sarah Ponzik is financial officer at UBS Private Wealth Management. She joins us now from Boca Raton, Florida, for her take on the market. Sarah, you've private wealth, so your clients are in this for the long term. But uncertainty can last for quite a long time. How do you rethink a portfolio to take advantage of upside, but also protection in this weird time?
Uncertainty can last for a long time. And what's interesting is, although you can say ever since we entered the new year, ever since the new administration took over, there's been uncertainty. It really hasn't been that long. It's only been a couple of months. But I think we can all agree it feels like a lifetime. And we have certainly seen it affect sentiment in sentiment surveys and also in, sentiment from our clients as well. Plenty of calls, plenty of emails. We're having conversations every day. But as to your question, Alex, of how do you think about this in terms of long-term portfolios and rejiggering portfolios? I think at the end of the day, we all have to understand volatility is here to stay. It's not going away. It's not as though tomorrow is Liberation Day. We're going to find out exactly what's happening with tariffs, and all of a sudden it's going to be smooth sailing from here. That's not the case. There's still going to be a lot of back and forth, a lot of ups and downs in markets, a lot of intraday volatility, and we have to get used to it. But something that I do think is very important for people to understand here is that in the past, 10% corrections, which is just about where we are on the S&P 500, have been great entry points into the stock market. And yes, you have to have a very strong stomach and be able to weather the volatility as it continues. But if you look at if you would have phased into the stock market at a 10% correction on average throughout history, you would have been well off into the future.
What are your clients doing, Sarah? Are they going to cash? Are they buying the dip? What are they doing?
So we've had some clients ask about going to cash, but that's not necessarily our recommendation at this point in time. One, I also think it's important to point out, if you're someone who's an investor and you are well diversified, you're also diversified in high quality bonds, some private investments like private credit, private equity. You're not only invested in tech in the market. Yes, it might be a significant part of your portfolio, but that's not your only investment. I think a lot of people might be surprised to understand that if you look at your portfolios year to date, you're maybe flat to down 2%. We really have not seen big moves yet to the downside that would really qualify as something extremely scary or extremely extreme. So when you think about the flip side, if you're going to go sell investments that you've held for a long time, go to cash, one, you're probably going to be facing a big tax bill next year because you're going to be taking realized gains at the end of the day. And no, you don't want the tax tail to wag the investment dog. You don't want to be the only reason you don't do anything. But it's more so investors and clients of ours who have had cash on the sidelines and who have been waiting for an opportunity. It's more so you take advantage of the stock market, you take advantage of this volatility, you get your cash to work slowly, and you also, do a risk assessment. If you're someone who sees your portfolio down 2% year to date and you're freaking out, maybe you have too much risk in your portfolio. That is a reason to de-risk.
It's such a good point. The other side of it is if we see rates a little lower, a little higher for longer. And there's obviously a debate for that because we're seeing a big bid into the bond market. Goldman Sachs now sees 3 cuts for the Fed this year. But if we don't get that because there is inflation and it's stickier, do you need to diversify more into higher yielding products?
Well, it gives you the ability to honestly sit in cash or buy bonds for longer and lock in interest rates. I know so many people have been talking about, locking in cash rates for really the past year and a half because the expectation where rates were going to come down, and rates just didn't come down as quickly as expected. They've been, pretty tough in staying where they are. So if you're an investor who still has plenty of cash, it's giving you this opportunity to lock in yields further into the future, buy quality bonds, and make sure you do lock in yields before rates come down. Our economists are of the view that, Fed Chair Powell has said that he expects any inflationary pressures from tariffs to be more so, I don't want to say transitory because everyone hates that word now after a couple of years ago, but, not long-standing. And that if there are more so pressures on growth, on the economy, if there are concerns about deteriorating growth in a recession, then our economists are of the view that the Fed, even with tariffs in place, would probably start to cut rates at that point in time too.
Sarah, dividends, are they important in the UBS kind of equity allocation?
They are. I would say dividends are certainly important, especially if you are an income-focused investor. I think the problem with solely focusing on dividends, there are some investors who just think, okay, I want to focus on equity income. I'm only going to invest in stocks that give me the highest dividend rates. A lot of times, those stocks, as you know, are value companies. And what's happened over the past 5-10 years, frankly, is if you've only invested or focused on that part of the market, is you haven't been invested in the very companies that have driven much of the gains over the last 5 to 10 years, being big tech and growth companies. So yes, I think having value in your portfolio is important, especially if you're an income-oriented investor. Looking for different ways to get income in your portfolio and not just from the bond market is very important. But I think you also want to be very careful in not focusing too exclusively on dividends, because if you had done that, you would have underperformed the S&P 500 pretty significantly, over the last cycle.
With the exception of the last 3 months, where value actually beat growth.
Yes, with the exception of the last 3 months. But I'm still not counting growth out and counting tech out. We still see the long-term growth potential of tech and growth. We don't think that what we've seen over the last couple of months is, a death knell to these mega cap tech companies. Oh my gosh, they're no longer what they were. We rather see this, as an opportunity to right-size exposure if you've been underexposed all these years.
Yeah, Sarah, great stuff. Really appreciate it. Thank you so much. Always good to get your perspective. Sarah Ponzik, financial advisor at UBS Private Wealth Management. But if you want to trade the value trade, man, just look at Europe.
Yes.
And how it outperformed in the last quarter.
Yep, and it's interesting. It was up about rest of world up about 6%. S&P 500 down 4.6%, and that differential is the greatest since the 80s.
Wow.
Actually. Yeah, just amazing.
I liked the close in the 80s. All right, now let's take a look for different asset classes here. Taking a look at the bond market. Yields again dropping. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joining us now. Is this a pure safe haven play at this point in the Treasury market, Ira?
Yeah, I think the Treasury market is just going to continue to be with risk on, risk off, right? So as we're risk off, the Treasury market's going to rally a little bit. Clearly, the ISM numbers, didn't help with new orders, falling quite dramatically. It's actually one of the sharpest declines that we've had in a non-recessionary environment. So I think, we'll continue to rally as long as we have this weakness. And by the way, I think I still have some of the clothes from the 80s, just so you know.
Yes, they come back. You got to recycle it. I'm with you.
The 80s was very
Feel
good
this.
for me. Ira, we had Richard Clarida on earlier this morning, and he said he doesn't know what's going on. I mean, do you think he's kind of representative of the Fed? The Fed's kind of like a lot of other parts of the market, and just waiting to see what happens tomorrow and in the coming days?
Yeah, the uncertainty is obviously very high, and that's obviously creating this risk-off attitude that market participants are having and will likely continue to persist. The thing that the bond market's kind of telling you, though, Paul, is that, look, the TIPS market's rallying quite a lot, and that's on the potential for slower growth. But it's also, you're seeing break even, so you're seeing the inflation expectation components continue to be sticky or even go up, particularly particularly in the shorter end, so 2-year, 1-year inflation instruments continue to think that show that you're going to have higher inflation, and that's all due to tariffs. So you are pricing in for some kind of slow growth, higher inflation, at least in the near term. If you want to call that stagflation, I think that that's reasonable. It's not stagflation like we had in the 70s and early 80s. That goes in the 1980s once again. But nonetheless, I think that the market is kind of starting to really price for that as the base case outcome for the economy. The question is, will the Fed have any kind of reaction function to that? We put out a note this morning suggesting that, look, the Fed is going to worry about inflation first, probably for the next few months, unless you wind up with some type of serious deterioration in the labor market. But then once it starts to cut, it's going to probably cut more aggressively than what the market's currently pricing.
Which, speaking of, did we learn anything from the JOLTS data that came out at the top of the hour?
Not a whole lot, because I think there is a lot of this uncertainty, right? So the job openings have been going up and down pretty dramatically over the last few months. I think that Friday's job number will be more recent, right? Because that'll be the March data, or at least the first look at the March data, and that'll be key. What I'll be looking for in that data on Friday is not only the number of jobs created, and of course, if the household survey shows something a lot different, because those have diverged quite a lot, the establishment and the household survey. But what have wages done? Because wages have been one of the big stories that's been helping prop up the economy and been allowing people to buy all of the services in particular that they've been able to continue to do, and that's been the most robust part. Services has been the most robust part of the economy. With higher goods prices, I'm fearful that we're going to have people paying more for goods that are necessities, and then actually contracting their spending on services. And that's one of the reasons why we think that we are going to finally get a pretty significant slowdown. It might not be a recession, but we could see a significant slowdown in growth, which might feel somewhat like a recession.
All right, Ira Jersey, thank you so much. We appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, based down there in Princeton, New Jersey. Speaking of the rates here, we do have a pullback in yields here. The 10-year Treasury is off about 7 basis points, yielding 4.13%. And the 2-year, no longer are we on a 4% watch. It's at 3.85%, so big pullback in rates. Gold edging just slightly higher. Bitcoin up about 0.9%, 83,100. A lot more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Another risk-off day. Stocks lower, bonds higher in price, pushing the yields lower. You had this at the top of the hour, the key gauge of manufacturing signaling a downturn and blame tariffs. Prices accelerated sharply in this. The factory orders, production, and payrolls all declining. Some firms are also halting investment. All 11 major industry groups in the S&P 500 are down right now. The Washington Post reports the tariffs to be announced tomorrow will have few, if any, exceptions and be 20%. Meantime, Jonathan Stubbs of Berenberg sees the end of U.S. exceptionalism.
Everything behind the U.S., which is what the Trump administration is doing, the rewiring of America, the remapping of the world, sets the scene for a different set of fundamentals to take U.S. equities forward. That's why it's a broken trade.
The S&P 500 right now, 17 points lower, 55.94 on the index. That's down 0.3%. The Dow down 260 points. The Nasdaq 100 right now 32 points lower. That is down 0.2%. So we're seeing it pair some of the earlier losses. Two-year yield down 2 basis points, 386. The 10, the benchmark, that is down 6 basis points. That is at 414. Worst performing stock in the S&P 500 right now, that belongs to Delta Airlines. It was down over 5%. Some of the airlines suffering analyst downgrades at Jefferies. They cite uncertainty, there's that word again, around consumer and corporate spending. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney were live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Sam Fazeli in the house. He's the Director of Global Industries Research. He's a Senior Pharmaceutical Analyst. He's based in London, but we got him in New York today in our studio today. Sam, I saw a story a few days ago that I know is important for your world, the biotech world, the pharma world. There's somebody at the FDA, Peter Marks. He resigned. Boy, the stock sold off. Why? Who was this guy, and why did the stock sell off?
Yeah, so he was, Paul, and thank you for having me in the room.
So good to see you.
Thank you. He was the head of the Center for Biologics Evaluation and Research, CBER. There are two of these. The other one's called CDER. And these guys were in charge of vaccines and biologics. So all the things that you get nowadays for the advanced cancer therapies, etc. So the rumor around is that he was pushed. So his resignation letter is out there for everybody to read. I think he specifically points out the decisions that are being made as regards this, or conversations that are being had as regards to the safety of vaccines, especially the measles, mumps, and rubella vaccine, which is, of course, quite topical. So he's left, and it's relevant because he was, you can't say the regulator is a friend of, no regulator is a friend of anyone, right? Their job was to try and get good, effective products through. And he was a fan of good, effective products. The issue is difference of opinion.
So based on that, like with the flu shot and updated COVID-19 shots, like the regular stuff that we get every year, RSV vaccines, can we get that? Will it be available? Will it be approved?
Yeah, so the best example of, the best way to answer your question is that the decision has been made already by the FDA for this year's, so next season's, flu vaccine. So those things are happening. It's more about how you communicate your view about vaccines and what people are saying, and therefore people's confidence in vaccines. Remember, vaccines don't save lives. Vaccinations save lives. These are not my words. Somebody much more sage than me said that. They got to be in your arm for that effectiveness to take place. And especially for something like measles, you need more than 95% of people to have been vaccinated, taking us to that, remember that story of herd immunity? Because then when you're not, your barrier is too low and infections happen. So that's where we're at, and that's what the issue is really more about, rather than vaccines being available.
And for an FDA, you need them to obviously regulate the industry, but if, as you say, if good drugs, good therapies come along and are proposed by the industry, you want the FDA to prove them in a timely manner.
Correct.
And this guy, apparently Peter Marks, was known to be somebody you could work with.
He was, absolutely he was. Now, there will be another person I'm assuming there has to be. So people have to lead these parts of the institution and be able to assess drugs safety and then efficacy. Are you paying? That is the angle. So I'm hoping, which the market currently, is in a world of shoot first, ask questions later.
Yep.
The market seeing this as a negative. There's a pressure on the FDA, and they don't know uncertainty, right?
Yep.
They don't know where it's going and when it will settle down. And it's everywhere right now.
And then you add on the layer of tariffs. What is the risk for drugs when it comes to tariffs?
Yeah, so we think that the biggest exposure is actually in the world of generic drugs, which is an odd outcome, because what you want to do is have generics available here for people to use because they're cheap. But a lot of the active ingredients are imported. So that's probably where it's going to hit most, unless there's some clever structuring around how the tariffs are applied. The bigger, more important drugs like our favorites, Wegovy and Zepbound, I'm sure they're being manufactured here. The question is, what does manufacture mean? Some bits of it are made somewhere. There are syringes that are involved. Where are they made? What do you call, where is that manufacturing, and at what point does it impact? If it's on anything that comes into the country from somewhere else, it will impact the price.
So what is your industry saying, the healthcare industry broadly defined? What are they saying about tariffs? Is this something they're not a lot?
Not a lot. They're just saying we can absorb it, we can manage it. Now, and also, again, with the uncertainty, what can you say, right?
Right.
Let's see what happens tomorrow.
Okay. Also, when it comes to generics, can you manufacture them here in the U.S.?
Oh, of course you can.
But what would that be like?
Oh, but you have to build the infrastructure, like the cars. You have to build the infrastructure.
What are we talking about? Billions dollars worth of investment?
I don't. Well, billions of dollars probably, but not tens of billions of dollars. The issue is also if the tariffs are just there as a tool to entice more trade, more fairer trade in the eyes of the administration, then that would be a way to solve it, right? Much quicker and easier. But if the ultimate aim is to onshore or reshore all the manufacturing, take it from pharmaceuticals to cars to whatever it is you want, then you want to be, they might have to be sticky for that to happen.
So what's the big theme you talk to your clients about these days? Is it a particular therapeutic? Is it a particular drug or disease? Or what are some of the big themes?
Across the board, to be honest with you. I have a couple of calls scheduled this week to talk about Moderna. Because of the uncertainty that you've seen the share price. Yep. Everybody's sitting there going, oh my God, vaccines, they're going to get hit. And they're a one product company. Okay. Let's be, the majority of the revenue comes from COVID-19 today. The same goes for BioNTech. So they get hit. And of course, but the rest of the world of biotech and science is trying to move forward and continue to innovate for people to do what we've seen in the UK. Death per 100,000 people has halved over the past 50 years, driven by many things, including better therapy and better medical care.
As we wind up getting a smaller HHS here in the U.S., et cetera, what's the knock-on effect for experimentation, creation of new medicine, therapies that we've been such a leader on for so many decades?
Yeah, so that's where there is a risk, depending on how this pans out in the end. There's been pressure on the NIH, there's been pressure on all the different agencies that are giving money for funding of research. What I don't know is, we all have examples. If we go into a lab, a local friendly research lab here in New York, you find things that have been done that look a little excessive. Budget X amount of money left at the end of the year, let's go and spend it because we have to, and buying this and that. So is this all about, let's break it down and rebuild it? And what if a private equity firm would do when they buy a company, right? And or is it a underlying distrust of science? I'm hoping it's not the latter. I'm hoping it's the former. Let's rebuild it to bring down this monster debt that the U.S. is dealing with.
Interesting. All right, Sam, thank you so much for joining us. Sam Fazeli, Director of Research for Global Industries and a Senior Pharmaceuticals Analyst at Bloomberg Intelligence. He's based in London. But we've got him in our New York radio studio, and that's a good thing. He's here in New York all week. So
all week?
All week.
Coming back. He's coming back, right?
I don't know. Look, see what he's got here. Yeah, we see what he's got here.
Always.
If he brings a bottle of wine from his cellar. If he brings a bottle of wine from his cellar.
Did you see him walking with a bottle of wine?
No, I did not.
Specifically asked for it, too.
Exactly. Exactly. All right, we're coming up. We got more. This is Bloomberg Good Morning.
listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. So every day we like to break down the big take story from Bloomberg. It's a deep dive into the economic, political, financial trends that we're seeing right now. And of course, the one today has to do with tariffs. And the title is Trump's Tariff Set to Make History and Break a System He Loathes. It just sort of states how important tomorrow is, whether or not it's for foreign policy, whether or not is it to raise money, whether it is about building stuff here right in the U.S. It is historic. And joining us now for more, Sean Donnan, Bloomberg News senior economics writer. Give us this full sweeping stake of what we could see tomorrow in historical context.
Yeah, look, I think it's a very simple story, and that is for almost a century now, U.S. presidents have had this break on their actions in terms of trade and tariffs, which has been the lessons learned of 1930 and the infamous Smoot-Hawley tariffs. And tomorrow, we're going to see a U.S. president kind of shed those lessons and move ahead with what is going to be the biggest act of American protectionism in a century and possibly more. I mean, our colleagues at Bloomberg Economics have done some work, and you can get very quickly to a point whereby the average U.S. tariff level rises to a point where it's the highest since the 1800s. And even if Donald Trump does something tomorrow that is less aggressive than the things he's telegraphed so far, it's still going to be a historic event, and that's simply because of the amount of trade that's going to be covered. And you saw that chart that you guys just put up, whereby the U.S. And its imports now account for 14% of GDP. Back in 1930, when the Smoot-Hawley tariffs went in, they only counted for around 5% of GDP. This is just going to be bigger in terms of scale tomorrow.
Sean, have we heard anything from corporate America in terms of how they view this higher level of protectionism?
It's really interesting. Companies tend to get very personal very quickly when it comes to protectionism. They start looking at their competition. They start looking at at the markets into which they're selling. And we've seen some really interesting dynamics in the lead up to this. Interestingly, Elon Musk's Tesla filed a submission to a U.S. Trade Representative's call for open comments. And Tesla said, actually, hey, be careful of these tariffs. They could actually reduce American competitiveness by raising the cost of manufacturing in America. On the other side of the coin, you have companies like Harley Davidson and Smucker, the big jelly maker, if you will. Well, it turns out that the J.M. Smucker company is incredibly worried about European or U.S. imports of European jam and the fact that it can't get enough jam or jelly into the European market because of what it sees as high tariffs and barriers there. So within corporate America, there's, you will hear from CEOs, and we've heard this a lot on earnings calls, a kind of broad concern about tariffs and rising protectionism. But when they start looking at their own business lines and when they start looking at where they sell and the barriers that they face or the competition that they face at home, some of these companies can turn pretty protectionist pretty quickly.
That's so interesting because we mostly hear about how companies are worried about tariffs here. You don't necessarily hear about the companies that really want them because they feel like they're getting treated unfairly. What about what publicly are these companies saying and talking to the White House versus internal conversations? Do we have a good sense of the gap between those two?
Yeah, look, there's, as you say, we get these broad concerns that are expressed in earnings calls, and usually when the CEOs are asked, these are not opinions that they're volunteering, although we saw Larry Fink from BlackRock yesterday in his annual letter talk about a rise in protectionism and the fact he saw people being more nervous about the economy than he'd seen in some time. Their engagement with the White House now is a bit of a black box. People have been more discreet this time around than they were during the first term. We've had fewer of these kind of public roundtables where the president is sitting with CEOs in the Roosevelt room or in the cabinet room. And so it's interesting. The sense we get is that a lot of corporate America is kind of discreetly saying to the White House, hey, let's be careful here, because the risk is that you're going to push the U.S. into a recession, and that's not going to be good for anybody. That's going to hurt corporate profits. It's going to hurt financial markets. It's going to hurt consumers. It's going to hurt the credibility of the president in the end. Now, whether the president is so married to this idea of tariffs and this kind of ideological view that he has, that he wants to remake the American economy and put a tariff wall around it, we will see tomorrow in terms of what's delivered. But right now, all the signaling out of the White House, out of this president, is that he's all in on tariffs and all in on this idea that it's time for a big, monumental, and historic change in how the U.S. engages with the rest of the world.
Sean, thanks so much for joining us. And folks, the article on the Bloomberg Terminal and on Bloomberg.com, Trump's tariffs set to make history and break system he loathes. It is a very detailed article, really explains a lot of the concepts here and kind of puts it all into perspective. So if you're looking for kind of like a primer on what we may hear tomorrow from the president, check out Sean's reporting with the rest of his team. Sean Donnan, Senior Economics Writer, Bloomberg News.
Yeah.
For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And we have a great lineup for you. Henrietta Trace will be joining us, managing partner and director of economic policy at Beta Partners, on what to expect on tomorrow from tariffs in the White House. Lorene Gilbert is CEO of WealthWise Financial to join us for how that impacts the market. And Michael McKee will be here from Bloomberg to break down the jolts and the ISM data that we got earlier in the hour. And Tim Craighead of Bloomberg Intelligence, top 10 companies to watch in the second quarter. One of them is a handbag company. I'm all in on that. But let's get to kick it all off here with a Bloomberg Business Flash. And for that, we go to Charlie Pellet. No. Oh, my God. Again.
I just don't I'm not even going to start with you.
Okay, but to be fair, a lot of times you leave in the 11 and then Charlie Pellet comes on.
That's not fair. No. Anyway, I'm just going to ignore you.
I looked at him and I said,
let's do the data. Data. Factory activity contracting in March for the first time this year. Prices accelerating sharply for a second month as the drumbeat of higher tariffs reverberate through the economy. Right now, the major stock averages, they have turned mixed. You have Tesla to thank for that for a large part. One of the best performing stock right now, you have the NASDAQ and the S&P 500 enter its sell-off. It's up right now about 4.8%. And the Bloomberg Magnificent 70 Index, that is up right now just over 1%. Meantime, Joe Quinlan at Bank of America says the market turmoil isn't over yet.
A lot of investors are happy Q1 is over and hoping for a better Q2. But let's face it, there's still going to be a lot of chop and churn in the markets as we get closer to the tariffs, and we're almost at peak uncertainty with the trade outlook, and I think that's important. We're not all there yet. We could see some more downside.
Johnson & Johnson shares, they are down right now 4.6%. New Brunswick, New Jersey-based Johnson & Johnson, after a federal judge rejected the healthcare product maker's third attempt to use bankruptcy to end the baby powder cancer claims. By the way, U.S. farmers boosting corn planting to a 5-year high as the trade war makes America's most widely grown crop a relatively safe bet. Domestic biofuel and animal feeding still account for about 75% of U.S. corn production. So that put that in your corn cob pipe and smoke it.
Absolutely.
S&P 500 is up 7. The Dow Jones Industrial Average down 45 points. NASDAQ 100 right now 73 points higher. Yeah, that is up 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm Charlie Pellet. Back to you.
Okay, maybe
Alex
in my
and
defense,
Paul.
today's like my Monday, so I have Monday brain. No, I'll take it. Cut it.
I can't even forgive you for this.
It's fair. It's the
Okay.
second time in like a week. I mean, I don't blame you. We're